Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
Let's take a look at stock futures. They're moving to the upside this morning after the latest read on inflation. The producer price index came in softer than expected. It's boosting sentiment and hopes for a September rate cut. So let's get right to it. The three things that you need to know to start your trading day. Yahoo Finance's Jared Blickery, Brooks Apama, and Madison Mills have more.
That's right. The Producer Price Index, or PPI, increased 0.1% in July from the prior month. That's less than 0.2 than the economists expected annually. Wholesale prices also came in less than expected at 2.2% versus 2.3%. Excluding volatile food and energy prices, the reading was flat. Now, stock futures are moving higher. Investor sentiment boosted by the reading. Attention now turns to the Consumer Price Index out Wednesday.
And big news from the green siren, shares of Starbucks popping after announcing Brian Niccol as the coffee chain's new chairman and CEO. Niccol, a name you probably heard before, will start on the role of September 9th. Starbucks Chief Financial Officer Rachel Ruggeri will serve as interim CEO until that time. Now, Niccol currently serves as chairman and CEO of Chipotle, and he was appointed there back in 2018. Shares of Chipotle are falling on this news this morning. Under Niccol's leadership, though, shares of Chipotle have soared nearly 800%. Starbucks writing in a statement, quote, "We are thrilled to welcome Brian. His phenomenal career speaks for itself. Our board believes he'll be a transformative leader for our company." Current Starbucks CEO Lakshman Narasimhan is stepping down as CEO and member of the Starbucks board, effective immediately.
And Elon Musk hosted a live stream interview with former President Donald Trump on social media platform X on Monday night. That interview was supposed to start at 8 p.m. Eastern. It did end up starting around 40 minutes later due to a technical delay. Musk blamed a cyber attack for that delay.
My apologies for the late start. We unfortunately had a massive distributed denial of service attack against our servers. As this massive attack illustrates, there's a lot of opposition to people just hearing what President Trump has to say.
Once the interview did get started, Musk and Trump discussed a number of topics, including inflation, immigration, and climate change. The former president did continue his verbal attacks against several groups, including the current Biden administration, saying if it weren't for Biden, the U.S. would not have inflation.
Futures in the green and yield lower across the board after the latest reading on inflation. The producer price index rising less than expected last month. Now investors are growing more confident of a Fed rate cut next month. Over 55% of traders now betting on a 50 basis point rate cut in September. That rose about 4% after the print. Here to discuss what this means for the broader markets and where we could go from here, we want to bring in John Stolfus. He is Oppenheimer's chief investment strategist. John, it's great to see you. So a perfect time to talk to you. We've got a number of key inflation prints obviously hitting the markets here. You've got PPI this morning. You've got CPI tomorrow. I'm curious, now that the markets seem to be pricing good news for the economy is good news here for the markets, I'm curious what your view is of this inflation print and ultimately what that signals for tomorrow.
Well, great to be on Yahoo Finance, Shauna. Got to say, when we look at this, it's positive for equities. It releases some of the dark sentiment that had gripped it over the course of the start of this month. We can't help but think that this gives the Federal Reserve opportunity to begin cutting rates. We think it'll be a 25 bips rate now in September, with likely another 25 after the election. Whether they do another one in December, I'm not sure, but we think it'll be September and November. We've been looking for a long time for the second half of the year to be 2 cuts, but we had thought after the election, but these numbers look good. They suggest that the Fed should get cracking when it comes to dealing with rates where they are. Put a down payment towards for both Main Street and for Wall Street in terms of where the direction is in terms of rates.
John, we've heard turbulence for the stock market become a much more frequently used word over these past couple of weeks now. How much of that turbulence is now attributed to what you were mentioning in people thinking the Fed has waited too long at this juncture, and what type of turbulence should they be bracing for?
Well, Brett, I've got to say that when it comes to when it comes to turbulence, turbulence is always potential for the market. You've got to expect that any time bears, skeptics, or nervous investors sense that there's a catalyst out there to take some profits amidst the bull market, without FOMO, they're going to take it. And everybody jumps on the drama. For intermediate to long-term investors, usually a good opportunity to look for babies that get thrown out with the bathwater. Really good stock that may have been a little bit too expensive before, now looking more affordable in here. Opportunity to further diversify portfolios. And then, of course, for the bears and the traders, the short-term folks, it's an opportunity to trade the bips and see what they can put in the cup, so to speak.
John, what should we be expecting on the volatility front? And I ask that now that we have earnings season winding down, a lot of that the driving force maybe that's expected to be behind the market is going to be dependent on these type of econ data prints. It's going to be dependent on what we're hearing from Fed officials. So how much more volatility do you expect that to then introduce here to the markets, given the fact that we are in this place of uncertainty right now?
Shauna, not a heck of a lot more than we've had, but always a potential for it on any tidbit of information, whether it's a data point or something related to even perhaps towards the presidential election that could cause some anxiety. But we'd have to say really not abnormal for this type of period. We're in a transition period right now. We're beginning to, it would appear to us that the Fed has already said, not just intimated, but it wants to cut rates. So we're towards the end of a Fed funds hike cycle. And the important thing is that we get an idea that the economy is not in a recession or moving towards a recession, but rather it's the end of a Fed funds hike cycle because enough is enough. We're normalized rates. Once again, bond issuers have to pay for the privilege of borrowing money, but maybe they can get it a little bit cheaper than what they've seen at the peak of this Fed funds hike cycle. And all in all, entering a new phase for the economy that is sustainable growth that will help the Fed meet its double mandate, which is essentially an economy that grows enough so that you don't have, but one that doesn't have too much inflation, but at the same time provides opportunity for full employment, which is somewhere around 3 to 4%, a little bit over 4%, perhaps unemployment to allow for transitions and changes in the job market.
So, John, just as we're continuing to kind of navigate our second half playbook here for the rest of the year, you're talking about the conclusion of the high cycle, a growth without an economic growth without exorbitant inflation. You've also got the election risk that you mentioned a moment ago. What is the largest catalyst that you think is going to drive the market in the back half of this year from this point forward?
I'd have to think, Brad, what you really need to see here is continued resilience in earnings. You know, when we look at the earnings season for this particular second quarter earnings season, which is almost over for the S&P 500, you've got earnings growth over 9%, revenue growth over 4%. And what it says is there's resilience. The pace of earnings growth is slowing somewhat, but you still have 5 sectors with double-digit earnings growth, and you've got only 2 sectors, last I looked, with negative earnings growth. This is a good thing. And so always, what's the market looking for? It's looking for a Federal Reserve that shows some sort of sensitivity to where inflation is, as well as it's looking for an opportunity to see revenue and earnings growth. That's what it's all about.
John, thanks so much for joining us here ahead of the opening bell this morning. We got to leave things there for today. John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. Good to see you, John.
Thanks.
We're closely watching a new C-suite shakeup play out. Starbucks shares in the green by 15% this morning after the coffee chain named Brian Niccol as its next chairman and CEO. Niccol, who you'll remember has been with Chipotle as their CEO since 2018, is going to join Starbucks on September 9th. Here to weigh in on the announcement, we've got Yahoo Finance Executive Editor Brian Sazi and Senior Reporter Brooke DePalma here. I mean, look, the shock that the brand of the green siren perhaps wasn't ready for this morning, at least investors in it, but also for Chipotle, there's going to be a significant kind of seat change there, and we'll see how that shakes out. Let's go to Starbucks first here and what we're seeing.
Yeah, so this was a recent decision. The company told Yahoo Finance that this was fairly recent. And it's important to note here that according to the company, this was an opportunity that they couldn't pass up. This was a decision made by the board of directors. And in addition to that, it also did have a bit of an influence from Schultz. Now, it's important to note here that former CEO and founder Howard Schultz has not been on the board since last September. But at the very tail end of the recruitment process, Howard Schultz did have a meeting with Brian Niccol once the board had already, seems like, made the decision to name him the next CEO. Now, this comes after former CEO Howard Schultz, called on Starbucks to do a major overhaul strategy back in May. This comes after the second straight quarter of same-store sales decline for Starbucks, and also as you had that ongoing pressure from two activists, Elliott Investment Management, as well as Starboard Value as of last Friday. And so investors really pleased on this news, and Starbucks expects the same response from shareholders.
Wow, I just came running on this set because I was working on our Invest
Could
conference,
not
guys.
miss
I was
it.
doing other things today. A couple things I will add this. First, what you're seeing is a Starbucks company that we all know and that we go to. This is a company in crisis. I just wrote about Starbucks last Sunday for the morning, or about a week ago for the Morning Brief newsletter. A lot of people that I were talking to inside the company and familiar with the inner workings of this company, saying the company is directionless. That Lax, who got publicly embarrassed on a competitor network by my former boss, Jim Cramer, about a month ago, he was unlikely to survive that type of very public embarrassment, was not a good look for him whatsoever. I'm also told that Starboard, which reportedly has a position in this company, person familiar with the thinking of Jeff Smith, telling me that this Brian Niccol is an amazing choice. And I would second that. Brian Niccol, I've followed his entire career going back to Taco Bell. Extensive board experience, had a good amount of board experience over at Harley-Davidson. He was recently, Brooke, as you know, was just added to the board of Walmart. So he is taking over another chairman position over at Starbucks. And then secondarily, let's keep in mind the work that he has done at Chipotle. He came in there right in the middle of that E. coli crisis. The stock, under a lot of pressure, worked a little bit with founder Steve Ells to get the brand going in the right direction. So this is a very accomplished, growth-oriented CEO, and Brian Niccol. And then I will also add this, the Howard Schultz era at Starbucks officially ends today. And that is a very good thing. It's about time that Howard Schultz gets out of that C-suite. He's chairman emeritus. He still has a parking spot at the company's headquarters. It's time for all these things to go. It's time for Brian Niccol to clean house and start thinking about life after Howard Schultz. Let's get it done. Let's make Starbucks great again, folks.
What do you think Starbucks is going to look like under Niccol? And it's very early to ask that, but I bring that up because given the success that you were just talking about from Chipotle, the number of things that he's instituted just in terms of some of the technological advances that have obviously really worked out for Chipotle, the culture, something that maybe Starbucks is lacking at this time. What do you think, any idea just in terms of how he's going to navigate that transition, or maybe what Starbucks is ultimately going to look like here over the next couple of years?
Mission critical number one. I think what you'll see over Brian, just having studied his career, first 90 days, he's going to get an understanding of the operations of the business, where there are holes and places he can fix. But number one for Brian, just studying him, he is very culture-oriented. This is someone that is championing a different way of doing business and treating employees inside Chipotle. Brooke, you know this too. I mean, you have store managers, people that start on the front lines of Chipotle, making well over $100,000 a year, becoming store managers of multiple stores. Brian Niccol is a culture champion, and Howard Schultz has not. Howard Schultz, when he came back as interim CEO, was tone deaf to a lot of the challenges that Starbucks employees are dealing with. Of course, Brooke, you've been covering the labor movement inside of Starbucks as well. Brian Niccol, I think, is going to finally solve the culture problem at Starbucks at the store level, and it's something they have to do if they want to improve their operations.
And this is also a question for both of you here, but you see the excitement playing out for Starbucks here in the pre-market. Flip that over and take a look at shares of Chipotle. Actually, they're under a pretty good amount of pressure here this morning. Chipotle without Brian Niccol at the helm. How worrisome is that for investors?
Don't sleep. We have Jack Hartung, Brooke, as you know, now taking over as interim CEO of Chipotle. He was supposed to retire. We just talked to him about 2 weeks ago or 3 weeks ago after earnings. So he was supposed to retire a little bit, perhaps look for his next gig. Jack Hartung has been there since day one with Steve Ells. He knows what he's doing, so don't expect any big changes at Chipotle anytime soon.
Yeah, and Chipotle investors, since Brian Niccol has joined the team, shares are up nearly 780%. And so when you think about the excitement that the investor community has around Brian Niccol and his leadership, it's clearly, showing in today's pressure, now roughly flat. But ultimately what we're seeing here is Brian Niccol just recently did a stock split. There's lots of excitement. Also lots of excitement among employees to be able to get in on such a successful business, have a share in the company. And so I think, like our Brian noted, I think that'll definitely bring that excitement over to Starbucks, something that Starbucks really has struggled with and really does need here. That excitement among employees and also the consumer base. You want a company that's widely talked about for the right reasons.
All right.
Brian Niccol, just lower prices. Give me $1 Starbucks cold brew coffee. And I think Brian could do it. I think he could do it.
Burrito, $12 coffee.
Go get it, Brian.
All right, well, Saz and Brooke, the two perfect people to have on set here with us to break down the story. Thanks so much to you both for helping us make sense of all of this. All right, turning now to the 2024 election. Tesla CEO Elon Musk hosted former President Donald Trump on an X live stream Monday night. But the conversation was actually delayed around 40 minutes due to what Musk blamed on a cyber attack on the platform. Once the conversation got going, former President Trump treated it much like one of his rallies, taking jabs at both President Biden and also Vice President Harris. Here's some of that conversation.
My apologies for the late start. We unfortunately had a massive distributed denial of service attack against our servers.
The inflation has killed them. Food prices are up 50, 60, even 100% in some cases. And this stupid administration allowed this to happen. This was a coup of a president of the United States. He didn't want to leave, and he was a horrible president, the worst president in history. And one of the reasons he was so bad, first of all, the Israeli attack would have never happened. Russia would never have attacked Ukraine, and we'd have no inflation. She's a radical left lunatic. And if she's going to be our president, very quickly, you're not going to have a country anymore.
Here with reaction, we want to bring in Henrietta Trace, the managing partner and director of economic policy research at VetUp Partners. Thank you so much for being with us here, Henrietta. So like we just played in that clip there, former President Trump insulting Vice President Harris several times, not necessarily a huge surprise, but referring to her as third rate, as incompetent. Lots of questions just about the context of this interview and what was discussed. I'm curious what your big takeaway from this conversation was.
Yeah, it was interesting. I mean, he definitely treated it more like a campaign rally than any kind of policy-oriented or move back to the center interview, which is what his staff on the campaign is actively hoping for. At one point, he compared Kamala Harris to Melania Trump, calling her beautiful. So it was definitely meandering. I thought that the biggest takeaway really came from Elon Musk and his indications that he wants to get more involved in federal government policy, specifically calling for the formation of a government efficiency coalition and commission, which sounds a lot to me like a deficit commission or the Simpson-Bowles commission we had several years back. And he effectively asked if he could be a part of that and join such a commission. So I thought of all the new policy developments, that was probably the biggest one last night from Elon Musk.
Yeah, I mean, and as we were considering, just the context of this interview as well. I mean, these are two people who largely need each other and need each other's platform to continue to get their message out, at least Trump needing Musk's platform right now, and Musk needing Trump to a certain extent if he's going to have any influence as well in the future of his own businesses and how well they do. We do know that there were the different glitches and whatnot. One standout from the conversation was Musk calling for, quote, government efficiency commission, which he says could help deal with reducing government spending. And he pitched himself to help with it. We're going to play this quick clip and we'll get your reaction on the other side.
I think it would be great to just have a government efficiency commission that takes a look at these things and just ensures that the taxpayer money, the taxpayers' hard-earned money, is spent in a good way. And I'd be happy to help out on such a commission.
I'd love it
if it were formed.
Well, you're the greatest cutter. I mean, I look at what you do. You walk in and you just say, you want to quit? They go on strike. I won't mention the name of the company, but they go on strike and you say, that's okay. You're all gone. You're all gone. So every one of you is gone and you are the greatest. You would be very good. Oh, you would love it.
Henrietta, I want to get your reaction. I mean, it seems like we've come a long way from drain the swamp and political interests and business overlapping.
Yeah, and I mean, you really have to think how that particular soundbite played with union workers. The former president's path to the election runs straight through Pennsylvania, which has an enormous union coalition and presence, and effectively he's praising the exact opposite of that. So have to wonder how the campaign felt about that particular soundbite, which I assume Democrats will seize on and make a lot of hay out of in the coming days.
But what do you think about the fact that he could be part of the administration, have some role in the administration when so many of these policies really drive the success potentially or challenges that we could see specifically for his businesses?
Yeah, exactly. So, next year we have to pass a tax bill, and extending all of Trump's tax cuts from 2017 is going to cost $4.6 trillion. The one thing that I heard from them last night is that they would eliminate the Department of Education to streamline federal efficiency. When you're trying to offset a $4.6 trillion tax cut extension, eliminating the Department of Education is just not going to do the job. So I think they are going to have to spitball a lot more specific policy ideas, most of which will have to include not extending some of those tax cuts. They're just too expensive if you're going to also prioritize efficiency. Secondarily, I'd say that it's interesting that J.D. Vance, his vice presidential nominee, is on the campaign trail this week talking about expanding the child tax credit to $5,000 for families. That is something that is bipartisan. Marco Rubio has endorsed that before. It's obviously a big part of the Democratic bills that have passed in the last 4 years under Biden. But this is a $1.2 trillion provision on its own. So if they're going to talk about efficiency, we really need to keep the numbers in perspective and make sure that we're having a discussion that's on par with one another.
All right, and Henrietta, I also want to get your take on the Harris camp and the reaction that we heard from Vice President Harris and her campaign, because we got a statement from the campaign in response to the interview, and it said in part, quote, that Trump's entire campaign is in service of people like Elon Musk and himself. He's self-obsessed, rich guys who will sell out the middle class and who cannot run a live stream in the year of 2024. What do you make of that rhetoric? And I guess what does that then tell you maybe about the strategy that we'll likely see over the next several weeks surrounding Vice President Harris and her campaign?
Yeah, it's certainly a different campaign than what we saw from either Clinton in 2016 or Biden in 2020. Bakari Sellers has this incredible line, which is, when they go low, we go to hell. And effectively, that is what the Kamala Harris team is getting at here. I mean, they've held Zoom calls that have broken records. They've generated over $500 million in the less than 3 weeks that she's been on the campaign trail. And so to mock Musk for not being able to get Spaces up and running in the same vein as the former Republican presidential candidate Ron DeSantis is particularly notable. So sort of hitting them where it hurts, I guess, is what we should expect from this campaign going forward.
Henrietta, thanks so much for joining us here this morning with some of your key takeaways from that X chat that took place, as former President Trump called it. Henrietta Trace, who is the managing partner and director of economic policy research at Veta Partners. Appreciate the time.
Thank you.
Well, shares of Truth Social, the parent company, Trump Media and Technology Group, sliding this morning. You're taking a look at ticker symbol DJT, down 3% pre-market after former President Donald Trump posting on rival social media platform X for the first time in nearly a year. Plus, the series of posts and campaign ads came ahead of the former president's live stream interview on the platform with ex-owner and CEO Elon Musk. I mean, he's supposed to be, and his team, working on a competing product for social media advertisers to flock to, views, listens, whatever that media platform that they've teased will or may look like in the future. Right now, still a larger question of profitability and viability there.
Yeah, I think it's maybe a bit of a surprise, at least to me, that we are seeing DJT under some pressure this morning, because we know that obviously it does intend to trade along with fundamentals, mostly surrounding sentiment. And you would think after a talk was held, after the discussion was held and really playing into his base, it's hard to argue that if you weren't a supporter of Donald Trump or if you weren't a supporter of Elon Musk, I don't think many of those people were listening to the call last night. So you would think that you would see a little bit more excitement. At least that was my initial take surrounding DJT. So this pressure, at least a little bit surprising. Maybe some of that is because this did play out on X and it did play out on the social media platform Truth Social. I don't know how much that is. Obviously, you're talking very different numbers when you talk about audience and the number of people who are on X versus number of people who are on Truth Social. But again, this movement here that we are seeing lower in DJT. DJT is a stock to keep in mind as we lead up to the election, just given the fact that it tends to move very much along with the sentiment surrounding former President Donald Trump rather than the fundamentals of the business. And that is a story that has been the case ever since this started trading publicly.
Yeah. All right, we're going to continue to track shares going into the start of trading. Coming up, though, Nvidia shares are moving higher on a positive assessment from Bank of America. We'll tell you why the firm named Nvidia a top rebound stock pick. That's next.
Another quarter of muted earnings here for Home Depot. You're looking at shares off nearly 2% in the pre-market. The company shares are falling after it lowered its comp sales and profit outlook for the year. The move coming as shoppers are pulling back on their spending and holding off on some of their major home improvement projects amid higher interest rates. That has been a story that has been a challenge here for Home Depot and its rival Lowe's. You're also looking at its rival Lowe's falling in the pre-market as well. On the heels of this, we're going to hear from Lowe's next week when they report their second quarter results. Again, that stock off just about 1.5%. But Brad, when you take a look at these latest numbers here from Home Depot and at least the quick reaction that we're getting from the street, obviously lots of concern about what some of that weakness is going to look like, at least here in the short term. There has been some acknowledgement of quote unquote some noise within the guidance revision here to parse through, given the outlook here that now includes that SRS acquisition. But again, lots of questions just about some of that weakness here, at least in the immediate term.
Yeah, Ted Decker, the president and CEO of Home Depot, saying during the quarter, higher interest rates, greater macroeconomic uncertainty, pressuring consumer demand more broadly, resulting in weaker spend across home improvement projects. Part of that consumer mindset as well is also once interest rates finally do start to come down and continue to impact mortgage rates to the downside, making it more of a market that buyers or even some sellers want to enter back into. Do they want to make sure that they have that cash available that they perhaps in the past would have put towards some of those DIY projects, and instead now keeping that in the coffers, saying, all right, when the market is ripe, we need to be able to deploy that. And so not as many of those projects coming Home Depot's way as of right now in kind of the frame of thinking across the board here. Let's take a look at the opening bell as you are watching the Morning Brief brought to you by Invesco. Let's do a quick check of the markets just after these bell ringers get done doing what they do, kicking off today's trading activity. You've got some funfetti at the NASDAQ, BYMA ringing the opening bell there, and ADT ringing the opening bell at the NYSE. Lots of blue there for ADT. Okay, yep, good stuff. Let's take a look at these markets. As we're taking a look at the Dow Jones Industrial Average, seeing good stuff there. We're up by about 0.4% to begin today's trading activity. S&P 500, you're seeing that up by a little more than 0.6%. And the NASDAQ Composite here out of the gate this morning, we are seeing gains on the screen. We're up by about 1% for the tech-heavy NASDAQ.
Here's a closer look at some of those gains that we're seeing. A lot of that driven by that softer PPI print that we got out before the bell this morning. Jared Blickery. Jared, what are you keeping an eye on?
That's right. I think the fireworks happen tomorrow on CPI, but investors are taking the PPI, which is a bit soft, and you can see green across the screen on the left there, even small caps bouncing back from that loss yesterday. Let's just take a look at the NASDAQ real quickly, up about 4 days. This would be the fourth in a row. Let's just check out the 2-day total. You can see it's up 1.25% for the week, and I think the Dow is just climbing back into positive territory. You can see basically unchanged for the week right there, although yesterday, very low volatility day. And speaking of volatility, we got to check in on the VIX, which has just been edging down. And check this out. It is below 20 again. Let me put the 10-day chart so you can see when it got all the way up to 65. It was up here on an intraday basis, and it has just kind of plummeted back down. That's a really quick move to the downside. So have things totally renormalized? I think we're due for another VIX spike, but probably not going to get nearly back up to 65. And that's kind of how those VIX spikes goes. They get smaller and smaller until they get bigger and bigger. So here's the MOVE index. This is bond market volatility. It's at the close, calculated at the close every day. You can see that's elevated right now. Want to get to the 10-year T-note and the US dollar. Those are heading down as well. Bit of a tailwind for risk. And then we got to check in on the sector action where tech is flying high. That's up 1.5%. That is a leading sector and the only outperforming sector of the day. Energy, the only one trading to the downside, that's down about 1%. And before I leave, wanted to check out gold because gold has been knocking on the door of yet another record high. Let's go to the year-to-date chart, and you can see just hovering up there, barely breaking through, but probably going to get another record on the close, right around $2,500. Guys?
All right, Jared, thanks so much teeing up today's trading activity for us. Well, China's Huawei is challenging Nvidia with a new chip for artificial intelligence, according to the Wall Street Journal. Huawei has reportedly told potential clients that the chip is comparable to Nvidia's H100. And there you're taking a look at some of the chipmaker activity early out of the gate here this morning. Nvidia kind of shrugging off some of those potential competitive landscape pressures that they could face from Huawei. Of course, what's important to note for Huawei is that they are also one of the major manufacturers of the top performing smartphone and handsets in the world. And so with that in mind, they would have less of a need or a reliance on some of the fabrication process and chip design process of the likes of an Nvidia or their current OEMs that are servicing them as of right now.
Yeah, so the reports say that this is comparable to Nvidia's H100 chip. And the reason why that is important is because that is a chip that is banned in China because of restrictions, because of questions about national security. So Nvidia had made chips that weren't as strong as the H100 here in the hopes of selling them to China. So the thought, I think, here, just some of the pressure that we could see on Nvidia is if Huawei is able to manufacture this chip that is as strong as the H100 or is as advanced as the H100 chip, then that, of course, could dampen some of the demand that we could see from Nvidia's chips that aren't as advanced. So I think that's some of the maybe things that investors need to keep in mind here as we think about what Nvidia's business could look like in China. Obviously, this is nothing new. When we talk about the crackdown that we have seen from the Biden administration on the export of advanced chips. They have been very vocal just about the national security issues and things like that, and have cracked down very much Nvidia, far from the only chip maker caught in the crosshairs of this. But again, the reports here that Huawei could be shipping this chip as early as October. Then, of course, the question is, what kind of pressure could this actually put on demand for Nvidia's less advanced chips in the region? So we shall see. All right, let's take a look at On Holding, because shares sharply in the red after the company missed earnings estimates for the second quarter. Revenue for the quarter was above expectations. The company did maintain its full year financial guidance. You're looking at gains of just about 2%. This stock had actually been off, I believe, just around 10% in pre-market trading. So it's kind of been trading all over the place. The initial concern surrounding On Holding was its DTC business, direct-to-consumer business, some weakness there. The fact that it did fall just short of the street's expectations. But in the quick reaction that I was actually going through here, Brad, how did the open was many of the analysts were saying that they would actually remain a buyer, especially if we did see any sort of negative reaction to that slight DTC segment miss. So it looks like the street, at least for now, maybe correcting some of that initial reaction. We're looking at shares trading to the upside, and much of that then the focus on the beats that we did see this quarter from On Holding and the relentless demand that we have seen for their products.
Yeah, a few things that On Running and On Holding we can expect to see from them. One is, and I think this is good for how they're trying to diversify the type of consumer that's buying their product, more of a push even into lifestyle. Of course, they've been very technologically focused on how they can enhance running and sport performance for a while now, and even expanding out into tennis a few years back as well. But now they've got partnerships like the one with Zendaya. We'll see if the Gen Z, the millennials like myself, if we are opting into that new kind of lineup as well. But overall, it really does come back to this customer environment for being very picky and choosing about some of the discretionary purchases, especially even if they're on the feet and you're trying to see if you can run on a cloud or not. They told me I was a leaper gatherer. I bring that up every time. I'm still a little bit offended, but it's all right. I'll move past it.
I think it's a good thing.
I think it is, as long as it makes me faster. But the one thing that they're pointing out here is really kind of looking back at this broader kind of worldwide runner and sensing some of the opportunities, and price point is what this is going to come back to. They have also been looked at as a brand that is on the higher tier of those price points. And it's brought up the rest of the industry, but when you have consumers that are pushing back on price, that can directly impact margins. Right now, they're looking to expect a gross profit margin of around 60%. And so we'll see if investors have to continue to see that perhaps moderate just a little bit lower in the near term if they do have to put in any pricing changes in the future.
All right, coming up, keep it right here on Yahoo Finance. We're going to take a look at how the markets opened today on the heels of that softer than expected PPI print. Again, you're looking at all three of the major averages trading to the upside here shortly after the open. Odds now are traders at least a little bit more confident that we are going to see a rate cut here in September. More on that when we come back. Stocks ticking higher ahead of tomorrow's crucial consumer inflation report. Now we're going to get the CPI print ahead of the bell tomorrow, but this morning's moves, and what we're seeing at the open, is in reaction to that PPI print that we got out this morning, softer than expected. Because of that, you're looking at traders pricing in higher odds that we actually could see a 50 basis point hike in September. Many are remaining confident that we are going to get some sort of cut next month. Now, here to discuss that and more, we want to bring in Dennis Gartman. He's a former editor and publisher of the Gartman Letter, also University of Akron's Endowment Committee's chairman. Dennis, it's great to have you here. So first, let's start on inflation and kind of the improvement that we have been seeing there. I'm curious from your perspective what you make of this back and forth that we have been seeing about the timing of when the Fed is going to cut, the degree in which the cuts are likely to be. How much does that matter? And what is the top thing that investors should be keeping in mind at this point?
It matters, no question about it. Early in the year, I found it laughable that there was consensus that we'd have 5 to 6 cuts in the overnight Fed funds rate by the year end. I maintained right from the start that at most we'd have 1, maybe 2, and I really didn't think that we'd have a cut until after the November election at the November FOMC meeting. But now it seems quite possible, in fact, it's highly probable that we'll get a 25, maybe 50 basis point cut in the overnight Fed funds rate at the September meeting. There's been talk, and I think it's egregiously wrong, that there would be a cut in the Fed funds rate before the FOMC meeting in September. That's not going to happen. But we're going to have cuts in the funds rate, no question about that. It'll happen after September or at the September meeting. And if I've learned one thing in 50 years of being involved in the markets, once the Fed changes its direction of policy, once they begin easing, they ease for a much longer period of time and take rates much lower than anybody had anticipated. When the Fed tightens, they take rates much higher for a longer period of time than anybody had anticipated. So when they finally do cut the overnight Fed funds rate, whether it's the September or the November meeting, that'll be the first of many cuts. We'll have 5 or 6 cuts, take the overnight Fed funds rate probably to 2 3/4 or 3% over the course of the next 2 or 3 years.
So with that in mind, Dennis, I mean, how deep could those cuts go and over that period of time, considering that some of the chief investment strategists out there are still commenting on this being an economy that could show growth without exorbitant inflation? I mean, what is the damage to the economy that the Fed would have to see in order to go down that pathway?
They'd have to see a rise in the unemployment rate above 4.5 to 5%. You're going to get that. There's no question that's going to happen. We'll probably be in recession when that occurs. I think we're already, when the data comes out, when the NBER, the National Bureau of Economic Research, makes its analysis and puts forth its report on whether we're in recession or not, they're always late. They usually tell us we're in recession when we're coming out. They usually tell us we're coming out of recession when we're going in. They are slow to make changes. I think given the fact that the leading economic indicators peaked 18 to 24 months ago, that money supply has been decreasing over the course of the past year or two, that consumer credit cards are extremely expanded, that we probably have seen the highs as far as consumer demand is concerned. I think in essence, we will see that we are in or are soon shall be in an official recession, and that'll be enough to take the unemployment rate above 5%, and that'll be enough to take the Fed funds rate to 2.5%. But that'll take a year or two. It'll be a long time in coming.
Dennis, I want to switch gears here and specifically focus on Nvidia. And I bring this up because you had made some comments recently, I think it was just about a month, maybe a month and a half ago, that the stock was egregiously overexpensive. When you take a look at the decline that we have seen in Nvidia since you did make those comments, and had been trading right around $100 a share. Now I believe today it's right around 110, 112 here this morning. Is it attractive at this price? How should investors be thinking about the opportunity to buy Nvidia?
I think clearly from the chart you can see that we made a high in July. I think each low recently has been lower, each high has been lower. I think we're in a bear market in Nvidia, and I would not be a buyer. I'd rather own consumer disposables. I'd rather own REITs. I'd rather own dividend-paying stocks. I'll avoid Nvidia. I missed it on the way up. I'll miss it on the way down.
Dennis, why do you think we're in a bear market for Nvidia? Just given the fact that the CapEx numbers that we got from big tech over the last couple of weeks, the fact that they are so dominant within this space, why are you taking that contrarian view?
Take a look at your chart again and cast a trend line across from the going back to last year. We've broken that trend line, no question about that. The peak was in July, and again, since July, middle of July, the lows have been lower and the highs have been lower. That looks to me like a bear market. Can I be wrong? yes, if we start to take out the recent highs made a week and a half ago, I'll be wrong. But I think if you look at that chart, that's a definitive and rather major top. So time shall tell. I thought it was egregiously overextended a month and a half ago. But then again, I thought it was egregiously overextended about a year ago. I've been wrong about Nvidia. I've been wrong about high tech. And I admit it openly and consistently.
Well, people can use all of the charting functions on the YahooFinance.com platform, Bollinger Bands, simple moving averages, what have you. Dennis Gartman, the Gartman Letter, former editor and publisher of the University of Akron's Endowment Committee's chairman. Thank you so much for taking the time.
Thanks for having me on. You guys you'll let almost anybody on the show these days if you have me on here.
You have some good takes, and we enjoy a diverse conversation here, Dennis.
Thank you, my friend. Good to see you.
Good to see you too. Investors are repositioning their portfolios after their expectations for global growth drops. We've got all the details after the break. Stick with us. Welcome back to the Morning Brief, brought to you by Invesco. Investor sentiment shifting amid concerns over the Fed's path to rate cuts, according to Bank of America's Global Fund Manager Survey. We've got Yahoo Finance's Josh Schaefer here with the details. Hey, Josh.
Hey, Brad. Yeah, so always a lot of charts to break down in this fund manager survey. Bank of America surveys over 500 fund managers. And the survey, interestingly, I think this is important to point out, was done from August 2nd to August 8th. So that means it started the day of that weak July jobs report and went throughout all of last week's volatile market trading. And one of the key takeaways for me was that you're still seeing investors confident in a soft landing. So the soft landing odds, the amount of respondents saying they see a soft landing hit 76%. That's the highest we've seen since the data set that Bank of America provides here, dating back to May 2023. The key other movement here would be that hard landing risk also went up. So what went away was the no landing. Remember, no landing would probably come with strong economic growth. So you're seeing a little bit of a bet there that essentially the overachieving U.S. economy is no longer where people are placing their bets at this point. And the key part to this that Michael Hartnett, who runs this survey, pointed out within it, is that this is driven by expectations for lower interest rates. So there's another chart that Bank of America provided here of how many cuts people are expecting. Interesting to look here. So purple is August. There was no bets on 4 cuts in the light blue or the pink line until a week ago. Now everyone, 60%, are saying 4 cuts or more. So yes, people are saying they feel like we can achieve a soft landing, but that comes with the expectations of quite a few Fed rate cuts. So it gives you the mind of how investors are thinking about this, that the soft landing is still achievable, but it's going to take some help from the Fed at this point.
But that kind of contradicts itself. Right? If you're going to be forced to cut 4 times, maybe even more than 4 times was that second line, I believe, you would be doing that because you think the economy is there's something very wrong, right? So I guess, and I bring that up because then it's almost like how much of this, and this really goes back to the conversation we were having last week when you take into account the market's reaction to everything that played out following the jobs report, everything that played out overseas or sparked by what happened with the Bank of Japan, is whether or not that's an overreaction and something that's going to be recalibrated very quickly, too.
Yeah, I mean, well, you look at, they have data on sort of where people put their money, too, right? And you saw the largest move out of stocks since September 2022 on a month-over-month basis, and you now see the lowest allocation to stocks since January 2024. The market got defensive. Investors got defensive for sure. But one thing, Sean, I was looking into this, I was thinking about what some of the economists have been telling us. So Seth Carpenter over at Morgan Stanley, the chief global economist there, he's calling for 3 rate cuts, so 1 less than 4. But he said he thinks if we get 3 rate cuts based on the current data and the data doesn't get worse, that's soft landing. Right. So we're not that far off. And he said the market's pricing a little bit more right now. And to him, that makes sense because the risks sort of to investors feel like they came out of nowhere. Yeah. But maybe it's just a fine line, right? Like the path has gotten significantly narrower, but the path is still there for now.
Yeah, and it's also consistent, right? Kind of just what we've been seeing the market price out in terms of rate cuts versus maybe what is the more realistic view. Even when it comes to what we've seen from the dot plot, even what we heard time and time again, the messaging from the Fed, and then versus what the market wants to hear and wants to believe.
Yeah, and then I wonder if we don't get the 50 that the market's pricing in, how are people going to feel?
Yeah.
Do we need 50 bids in September for you to get your soft landing? I don't know, but that's what the market seems to want right now, and is that going to move over the next month?
And then even that conversation, we got to go here, but even that conversation I feel like has kind of shifted over the last 1 or 2 trading days, just in terms of the need for 50 versus the want of 50, and more realistic.
To me, it's more of a want right now than a need, is what it seems like.
Yes, definitely. We'll leave it there. Lots more to discuss because a lot comes out of this Bank of America Fund Manager Survey. All right, Josh, great stuff. Thanks so much. Keep right here on Yahoo Finance. Right after the break, we're going to be taking a closer look at some of the largest trending tickers here today on Yahoo Finance. The biggest stocks on the move here this morning, just about 30 minutes into the trading day. We've got that for you when we come back.
Welcome back. You're watching The Morning Brief, brought to you by Invesco. We're taking a closer look at Yahoo Finance's trending tickers right now. Tencent, Intuitive Machines, and Sea Limited, CEA Limited. We're doing it in 30 seconds each. or our best effort. Let's go. Tencent shares are ticking higher after a smaller than expected fall in its quarterly revenue, thanks to a rise in paying subscribers on its music streaming platforms. They're taking a look at the move here right now. We're up by about 1%, but let's take a look at that longer term chart here for Tencent. Of course, as we're continuing to keep a close tab on how this company is moving year to date. It was having a rough first quarter, but ultimately has rebounded and moved to the upside by about 30%, just shy of that. So we'll see how they're able to continue to build on that shareholder value.
All right, let's take a look at Intuitive Machines. Shares are sliding this morning. The space exploration company sales for its second quarter missed the street's expectations. We're now actually looking at losses of only about 0.8%, had been down more than 2% not too long ago. Now, despite the miss, though, Intuitive Machines raising the lower end of its full year guidance, also reporting a surprise profit. And I was just reading briefly here about why maybe we aren't seeing a more optimistic reaction to that surprise profit. It seems like consensus here is that more of the focus is on sales at this point. Also, once you dig down into that profit, it takes into account that Intuitive's operating loss in the quarter still amounted to $28.2 million, which was higher than the $9 million loss that analysts had been expecting. So a bit of a disappointment there.
All right, I'm so glad that I got Sea Limited here to talk about Sea shares surging after the consumer internet company beating revenue expectations in its second quarter, but its EPS falling short of the street's estimates here. Wow, shares moving higher by about 7% as of right now. Some of the highlights here. Overall, you did see gross orders in their e-commerce business total $2.5 billion for the quarter. That increased by 40%, a little more than 40% year over year. And then their entertainment side of the business bookings were up 21% year over year. All right, we did it almost in 30 seconds each.
We did. All right, let's keep right here on Yahoo Finance. We got Catalyst coming up next. We're going to dig in to the reaction that we're seeing here at the open. Again, stocks moving higher across the board. But what you've got up on your screen is actually Starbucks and Chipotle. A huge announcement out before the bell this morning. Starbucks has a new CEO, Brian Niccol. He was the CEO of Chipotle as a result. Seeing Chipotle shares under pressure, seeing Starbucks actually trading to the upside. Got much more on that coming up next on Catalyst. just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today.
Stocks are higher after the producer price index came in softer than expected, indicating continued progress on the fight to cool inflation. Investors pricing in nearly a 50-50 shot of both a 25 basis point or 50 basis point to come from the Fed, 50 basis point cut to come from the Fed in September. That's according to the CME Fed Watch tool.
And Starbucks naming Brian Niccol as its new CEO. That's effective September 9th. Niccol has been a driving force for Chipotle. Shares are up nearly 800% during his tenure. Will he be able to turn around Starbucks' business? That stock down nearly 19% year to date. We'll discuss.
And we've got more signs of consumer weakness in retail earnings. The latest from Home Depot, the company anticipating comparable sales to decline by 3 to 4% after previously anticipating just a 1% decline. This marking the 7th quarter of negative comp sales for the company. We'll discuss what this could tell us about other retailers and the broader health of the consumer. But first, we have to talk about the current moves in markets. About 30 minutes into the trading day, the Nasdaq leading the climb higher, up almost 1.5%. The Dow is moving to the upside now, up nearly 120 points. And this coming as producer prices have shown that inflation is continuing to moderate. Now, the question is, can the trend continue with consumer prices tomorrow, and how will it impact markets? We've got Max Kettner here to discuss. He's the chief multi-asset strategist at HSBC. Max, it's great to speak with you. So let's just start on this PPI print. How indicative of of CPI is the PPI numbers that we got in this morning?
Yeah, good morning. I don't think it tells an awful lot about the CPI tomorrow, but in terms of the personal consumption expenditure index that we get a little later this month, it is certainly good news that that is slightly lower than expected. But I think for the CPI tomorrow, it's of limited use. But still, I think there is a decent chance that, both growth and inflation are actually continuing to head into the right direction. And I think particularly with regard to the last 2 weeks, certainly better than some had feared just a week or a little over a week ago.
So Max, what does that tell us just about, I guess, the progress that we have made, maybe the volatilities? There certainly is still a lot of uncertainty within the market. We just had the Bank of America's fund manager survey out this morning talking about the fact that, yes, investors are a little bit more confident that we are going to see a soft landing, but many are still pricing in or expecting or would like the Fed to cut 4 times this year. So talk to us just about how that contradicts itself and maybe what that tells us just about some of the uncertainty that is at play right now in the markets.
I don't think it's actually contradicting itself. I think it's actually quite helpful going forward. If we look at the next couple of months, I think the really, really worrying sign would be if you saw all fund managers, all portfolio managers agreeing with each other and saying, yeah, absolutely, it's going to be a soft landing. There's no way that there will be a recession. There's no way that inflation is going to pick up again. There's no way that there's other risks on the horizon. Everything is rock and roll. I think that would be a concerning sign. So, in fact, I think the fact that you still have a lot of people still worried about some sort of tail risks, perhaps even about an inflation pickup again, or a more severe growth slowdown. That, in fact, I would take that as a bullish, as a positive sign, because what it does, it really keeps sentiment and positioning in check. It really prevents sentiment and positioning from becoming too exuberant. I think if we had really everyone agreeing with each other, and then sentiment and positioning on much more bullish levels, it'd be really quite concerning because we would lack then the sort of the next marginal buyer. That, to me, would be the big risk. As long as we don't have that, as long as we have that healthy degree of disagreement in the market, that is, in fact, quite bullish because that allows days such as today.
Max, forgive me here, but your note sounded a little rock and roll-y to me because you basically said every potential dip off of data, that's a buying opportunity. Sounds pretty optimistic from my point of view. What kind of data surprise would not be a buying opportunity in your view?
Yeah, look, I guess if we get, let's say, labor market data, for example, that shows very broad-based weakening. If we were to see, for example, jobless claims that are weakening in 10, 15 different states, which are driven differently than perhaps by seasonality issues, or not driven by weather-related effects, such as we've seen that pickup in claims in Texas, which was clearly related to Hurricane Beryl. If we saw a bit more of a broad-based pickup in claims, if we saw much fewer industries hiring. So if we saw in the non-farm payrolls really a sustained slump in the amount of industries that are net hiring, I think that would be concerning, because it would be really clearly actually pointing to perhaps a slower and a more broad-based slowdown. Whereas what we've seen so far is it's either really related to one-offs, whether related, or it's related to seasonality. So we can explain it away. Once we see a bit more of a severe broad-based weakening that we cannot explain away by those special factors anymore, then I would be concerned. But as I said, we don't have that at all at the moment. We're nowhere near at that point at the moment.
So Max, if the fundamentals are still in good shape, there's still reason to be optimistic then just about where we are in the cycle. What does that then tell us about positioning, and should investors still be allocating more towards the riskier assets versus getting defensive then at this point?
Yeah, absolutely. I think 100%, even at these levels, we're still in buying territory. Look, I think, let's imagine on Thursday we get retail sales 0.1%, 0.2% down. Yeah, you can get another dip, you can get a bit of a setback, but you've got to ask yourself the question, is that enough of a slowdown? Is that enough of a negative surprise that that one data point is really going to challenge your constructive view? And we would clearly answer no, because when you look at the nowcasts for GDP for the third quarter, we're still tracking at 3%. No? So it is still a very, very healthy growth backdrop. And even if we had some downside surprises, fine, then you may only grow at 2 or 2.5%, but that doesn't challenge your overall constructive view. And that means you should still be adding to equities in particular, right, which should be leading the rebound here. So it really still argues for a very, very risk-on and constructive view.
All right, Max Kettner, always great to get your insight. Thanks so much for hopping on with us here this morning. Chief Multi-Asset Strategist at HSBC. Thanks so much, Max. Well, a C-suite shakeup. Starbucks shares soaring on news that Chipotle's current CEO Brian Niccol going to be taking over at the coffee giant. That's effective September 9th. On the flip side, we're looking at Chipotle shares under pressure here in early trading, off just about 13.5%. Now the big question on the street is whether or not Brian Niccol is going to transform Starbucks, and is he going to be that catalyst for the stock? We want to bring in Nick Setyan. He is the managing director of equity research at Wedbush Securities. We also have Danilo Gargiulo. He is a senior analyst at Bernstein. Great to have both of you. Nick, let me start with you. When you take into, I guess, the street very obviously excited about Brian Niccol being the new CEO of Starbucks, what do you think of his appointment and whether or not he's the right person for the job?
Look, I mean, the excitement is understandable, but if you go back and remember, when he came into Chipotle from Taco Bell, his job was to bring back, the loyal customer that Chipotle had lost because of the food crisis. His challenge here is to basically go after a new customer. And at the time, Chipotle had never done any kind of marketing, never any kind of menu innovation. The digital ball game was behind. So he brought in a lot of that because of his marketing background. And here, I'm just not sure what, he's going to be able to bring to the table at Starbucks. I mean, given the decades of experience around menu innovation, the digital, obviously, a game here. And again, unless he has the power to change macro headwinds to bring the lower income customer back to Starbucks, I'm just not sure what the game plan can be.
Dan, I want to bring you in here. Do you think that Brian is going to be a big enough tailwind for Starbucks to turn the stock around?
I think so. I mean, look, the example will be what happened with Chipotle. Just as Nick was saying before, there was a problem with really reigniting the consumer base after the food crisis that Chipotle has seen during the 15-16 era. And when Brian Niccol came in, the brand eventually became much more visible. And he started with this social media strategy that made Taco Bell today probably the most iconic brand for the Gen Z, which is, coincidentally, the part of the consumer base that is now fading at Starbucks. So I think he might have some toolkit that he could be playing into the Starbucks rebound era.
Danilo, what do you think, just the early assessments are that are taking place right now? And I guess as we try to figure out maybe what Starbucks is going to look like here, Danilo, under Brian Niccol, is it going to be very different, radically different than what we saw under Lakshman?
I think Brian has navigated some pressures that are very similar to when he was at Chipotle, that are very similar to the ones that we are seeing today at Starbucks. Thinking through the improved mobile ordering experiences, creating some digital lanes to increase the off-premise demand, which is part of the reasons why Starbucks today cannot serve its customer base. Diversifying the supply chain, investing in people and labor, but also using some prudent pricing strategy, which created this positive value perception gap versus the peers that is really propelling Chipotle's stock and Chipotle's performance these days. So all these toolkits are predicated on the premise of moderation, right? I don't think that Brian is going to come out and propose any bold strategies straight away that are going to be turning around Starbucks in the near future. But the toolkit is out there, and he's proven himself over and over. And by the way, one of the things that he's done while he was at Chipotle was to move the headquarters from Denver to Newport Beach, which in a way kind of separated himself from the former leadership and from the former founder, but also created a wave on new people, new management coming into Chipotle to make it much more relevant for consumers going forward.
Nick, just to follow up on the point that Danilo was making there, what should investors be anticipating the timeline for this recovery to potentially look like? If it is going to be true that Brian is going to be able to apply these strategies and turn the stock around, how long might that take?
About 3 quarters. Once the anniversary, the negative 7% comp in Q2, I'm sure Brian will be credited with having turned Starbucks around. As you can tell, I'm a big skeptic here in terms of what Brian Niccol can bring. I think the challenges are much bigger, but obviously, given the comparison of a negative 7% year over year kind of down comp in Q2 and in their fiscal Q2. I think they'll have a decent comp going over that, and that's when you'll kind of see some of the fruits of his labor.
Nick, do they need to lower prices?
I think it's going to be very difficult for them to lower prices. I think they can potentially go down a different strategy around a different menu, et cetera, or some kind of change on the margin in the menu to have lower prices. But ultimately, their challenge isn't the current customer, right? Their challenge is not the loyal customer. They continue to come in. They continue to spend more and come in more often. The challenge is going after that newer customer, and I think it's a challenge that Brian hasn't necessarily tackled previously.
All right, and Danilo, let's talk about Chipotle, because clearly we're seeing a lot of that excitement play out in Starbucks. If you take a look at Chipotle shares, they're under a tremendous amount of pressure this morning. Is that a bit of a surprise, given the fact that Jack Hartung, it sounds like the company is saying that he's now going to be staying on indefinitely, and maybe the shape or direction here of Chipotle might not change, maybe to the degree that Wall Street seems to be nervous about here this morning?
Yeah, I will agree with your assessment. I think it might have been a little bit of a surprise given the sudden change in Jack's role at Chipotle. But at the same time, I think the brand has evolved itself from being just a CEO-driven and CEO-led. And I think over time, it has proven itself that it's larger than its own management. Now they have really propelled this virtual cycle with the younger consumer base, having tapped into, new set of the population that previously was probably not being considered for Chipotle. Think about the importance of the Chipotlanes that is tapping into the, more convenient-oriented consumer. Well, those type of consumers are now much more familiar with the brand. And we are seeing that Chipotle is now working also in the small town, in university cities, areas where previously one would have never thought that Chipotle might be working. And so right now we're talking about potentially a cookie cutter approach that Chipotle will need to be deploying into more areas and expand the number of units, which again, while we like, Brian's leadership at Chipotle, I think the brand has evolved beyond his management.
Well, I think that's a really interesting point, Danilo, and it points to even further confusion about the degree of the pressure that we're seeing on Chipotle stock this morning. Nick, I want to give you the final word on this. Given the pressure that we are seeing the stock under, what does Chipotle have to do moving forward? Do you think it's just a continuation of the same and they'll have their say at the next earnings print?
Yeah, look, I think Chipotle's in a very good place, and I think they're in very good hands. Both Jack and both gentlemen here that are taking over. I credit both of them with the turnaround as much as I credit Brian Niccol with. So I think they're in very good hands. I think they're on autopilot, frankly, and not much has to change.
Danilo, I actually want to get one more quickly on you. I'm curious to what extent Starboard impacted the executive shakeup that we're seeing today. What's your take on that?
Hard to say. I would say clearly the investors were disappointed with management, both current shareholders as well as wannabe investors into Starbucks, and I think they've aired their frustrations over a long period of time. I think activists might have taken a decisive role into establishing the path forward for Starbucks. I don't know if that means that Starboard was, necessarily the kind of the investor poaching, quote unquote, Brian Niccol out of Chipotle. I think it was probably indicative of the wider investment base being a little bit frustrated with current management at Starbucks.
Danilo, was it more so the second quarter earnings, the disappointment there, the fact that they hadn't really proved that turnaround story? Could that also have, I guess, how much of that do you think contributed to this change and the timing of it?
Yeah, I think the conversation with investors that we've had indicated that investors were looking for upward trajectory into the quarter, meaning they were probably expecting to see some softness in Starbucks, but at the same time, they were hoping to see some exit rate being higher, indicative of the fact that the actions that management was taking were the appropriate ones, were the ones that would be able to make Starbucks get out of this situation of losing their customer base, as well as being unable to tap into the new consumer base, as Nick was saying before. So I think the frustration was less about the amount of decline and much more about the lack of positive catalyst from here on and positive trajectory into the performance.
All right, guys, we're going to have to leave it there, but really appreciate you joining us this morning. Nick Setien, Managing Director of Equity Research at Wedbush. We also had Danilo Gargiulo. He's a senior analyst over at Bernstein. Thanks, guys.
Thank you.
Thanks for having us.
We're going to turn now to the latest from the 2024 presidential race. Former President Donald Trump's interview on X with CEO Elon Musk drawing a lot of ears and some critics on Monday night. Musk saying in a post on the platform that the combined viewership on the interview and subsequent discussion by other accounts hitting 1 billion views. The two spoke a lot about their relationship as well as potential positions for the CEO in Trump's cabinet if he gets elected.
Well, I appreciate that. That endorsement meant a lot to me. Not all endorsements mean that much, to be honest. Your endorsement meant a lot. You're an amazing guy. You've done an incredible job and a great inspiration to people. A great inspiration.
I mean, I think it would be great to just have a government efficiency commission. I'd be happy to help out on such a commission.
I'd love it
if it were formed.
Joining us now with more on Trump and Musk's relationship and what it could mean for the election, we've got our very own Rick Newman. Rick, thanks for joining us to discuss. I want to talk about what we just heard there. Trump also in the interview calling Elon a cutter, referring to his positions on tax policy. What's your take? What's your reaction?
I was cringing all over again listening to those couple of snippets. I mean, this was just two self-important guys complimenting each other for 2 hours. Very tiresome, frankly, as entertainment, and it was not very informative. Trump just went through his usual litany of complaints and lies. And, just one example, he says all these migrants coming into the United States, they're all being sent here from prisons and insane asylums in Latin American countries. That's not true. So you did hear Elon Musk there raise this idea of something he called a government efficiency commission, as if nobody has ever thought of that before. Breaking news, Elon, there have been many so-called government efficiency commissions, and the answer to the problem of how to rein in all this American debt is not that complicated. You raise taxes and you cut spending. So I guess Elon thinks that no one was able to figure this out before, so he'll come in when Trump wins and he'll do it. He'll get the job done. So other than that, I mean, we didn't really get anything new from Trump last night. Nothing new in terms of policies, and it went on for 2 hours. So I'm not sure of those billions of views. I'm not sure how many people were still sticking around by the time this ended.
Yeah, it was tough to keep my eyes awake towards the end of it there, Rick. I was questioning when it was going to end at some point. But
well, it also started 45 minutes late after technology snafus. I mean, What's the problem here, guys? I mean, this never happens when you do a radio or a TV interview. And most operations can get an interview mounted without 45 minutes of delays. So sorry, just a personal rant there.
It was a personal rant, and I was struggling, obviously, along with thousands and thousands of other people struggling to get onto the live stream for quite some time until they were able to correct the issue, which, of course, Elon Musk blamed on a cyber attack as well. But Rick, let's move on and talk about maybe a differencing here of opinion, or difference of opinion between Musk and President Trump. But this is something that we have talked about time and time again, but ultimately what a Trump presidency would mean for Elon Musk, for his business, given the fact that he has a push, obviously, and a stake here in sustainable energy versus what former President Donald Trump wants to do, which is potentially drill more. So let's hear what that exchange was like last night.
I think we want to just move over, and if I don't know, 50 to 100 years from now, we're I don't know, mostly sustainable, I think that'll probably be okay. People can still have, a stake, and they can still drive gasoline cars, and it's okay. It's not. I don't think we should vilify people for it, but I think we should just generally lean in the direction of sustainability.
So that was Elon Musk pushing back just a bit. But Rick, my question to you is, a Trump presidency, how detrimental, how worrisome should that be, would that be to Elon Musk and his businesses?
Well, there's been an interesting Musk effect on Trump, which is that, he has vilified electric vehicles, EVs, up till now. And last fall, when the United Auto Workers were on strike, Trump went to Michigan and said, EVs are going to put you all out of jobs. They don't go far enough. He treats them as if they're toy cars. And now all of a sudden at his rallies, he's starting to say, well, maybe EVs are okay. And that's obviously Elon Musk kind of whispering in his ear. There's an interesting thing is happening to Tesla, which is it was a lot of, people in California, which is obviously a Democratic state that leans very liberal, who were Tesla's early adopters, the people who kind of got this company over the top and helped it become profitable. And now there's a lot of Tesla regret among those buyers who don't like the fact that Elon Musk has become kind of this right-wing dude. So Tesla is kind of becoming a MAGA brand, if you will. So that's one thing to watch for the next 4 years if Trump wins.
Well, Rick, I guess the final question that we have is what's going to happen in terms of any impact on Tesla stock moving forward. That's obviously the Yahoo Finance angle here. So just mentioning to folks that we're going to continue to cover that with our very own Pras Subramanian coming up here. Rick, thank you so much for joining us.
Bye, guys.
That was Yahoo Finance's Rick Newman. Coming up, we've got more of today's top movers on the other side of this break.
We got some trending movers 45 minutes into today's trading session, nearly an hour actually into today's trading session. First up, let's take a look at General Motors. You're looking at losses of just about 0.4%. The move to the downside coming after the company reportedly starting to lay off its staff in China, some of its staff in China. That's according to report out from Bloomberg here. Right now, I'm still going through this, but as it stands, GM is cutting its staff in the Chinese market-related departments. That's including research and development. This is according to sources familiar with the matter. Again, this report solely coming from Bloomberg. Yahoo Finance has reached out to GM, but has not heard back yet. In the coming weeks, GM and SAIC are expected to discuss possible capacity cuts as part of the strategic redirection for American nameplates sold in China. Again, this reporting here from Bloomberg, but this points to the question as to what exactly the future of GM obviously looks like here in China at a time when their business has been struggling just a bit, and how quickly they are able to turn around that business, or if they're going to start outsourcing some of that.
Yeah, and I think the important thing to talk about from an investor perspective, along with what you were saying, Shauna, is just that this is sort of a recognition from GM that their peak sales levels, which were occurring back in 2017, that those might be under some pressure. And that might continue moving forward, particularly as they do sort of make the strategic shift over to EVs. That could be more the focus here in terms of factory capacity as they kind of look to rejigger the job market underneath their own hood. All right, well, moving on here to another stock we're looking at, Bernstein moving to the sidelines on Warner Bros. Discovery after what the firm called an ugly quarter. The analyst downgrading the media stock to market perform from outperform. Yahoo Finance's Alexandra Canal is here with details. Hey, Ali.
Hey, Maddie. Yeah, Bernstein essentially downgrading the stock after last week's earnings. They called it a, quote, ugly quarter. Let's be honest, it was very ugly. We saw misses on both the top and bottom lines, a massive $9.1 billion impairment charge related to its TV networks unit following the loss of those critical NBA media rights. So that basically devalues the linear networks, which is something that we saw from Paramount Global as well. And it just speaks to the larger challenges that a lot of these legacy media companies are dealing with as their linear networks basically are in free fall at this point, while they're also trying to make streaming profitable. And speaking of that, WBD did report a reversal of earlier profit trends in its streaming business despite adding 4 million subscribers in the quarter. We also saw free cash flow fall 43% year over year. So just consistent bad news across the board here. And all of that did send the stock down by double digits after that report. Shares actually touched their lowest levels since the 2022 merger. They're down about 40% since the start of the year. Now, there are other firms out there like KeyBank, for example, which think the stock is attractive at these cheap levels. We do have shares trading below $7 at this point. KeyBank analyst Brandon Nisbell, he said it's, quote, unlikely things can get worse from here, and that in 2025 we should see more improvements in streaming along with the studio side of the business. But for now, there's not a lot to be desired here when it comes to Warner Brothers Discovery, and it's going to take an investor that is very patient if you want to get in the game now, which is why Bernstein wants to remain on the sidelines at this point.
All right, Ali, well, thanks so much for bringing us your reporting on that, as always. Appreciate it. Moving on to another ticker, we're looking at shares of On Holding, still under pressure, actually returning to the upside. The stock is up over 3%. Now, this does come after the company missed earnings estimates for the second quarter. Revenue for the quarter, though, was above expectations, and the company did maintain its full-year financial guidance. And this is a stock that has been moving around here, but we should note the success of On Holding over the course of the year. The stock is up nearly 50% year to date, as this is one of the shoe companies that's been able to perhaps take a little bit of market share over from a company like Nike that has been under pressure consistently for the past several quarters. There was a little bit of a disappointment on their direct-to-consumer number, in particular in their earnings guidance, but it looks like the shares have sort of recovered following the market open after an initial downside move.
Yeah, and I think a lot of that just talks, when you mentioned the fact that the stock was up nearly 50% since the start of the year, the expectations are very high. We talk a lot about how high the bar is for earnings this quarter. So even when some companies are meeting expectations or a slight miss in this case, when it comes to the DTC business, just in terms of what the street had been expecting, we did see that initial pressure on the stock. But here we are just about an hour into the trading day. You are looking at gains. And I think a big reason for that is because there was a lot to like in this report. You take a look at net sales that soared nearly 28% here from just about a year ago. You look into the fact of what their guidance and what they are expecting here going forward. They also went on in this earnings report to say, this is the company saying that On has experienced a very strong first first half of 2024 with 2 consecutive record top-line quarters and continued strong demand across channels, across regions, and product categories. So again, there was a lot to like, and also that full-year guidance of at least 30% net sales growth on a constant currency basis. The fact that they did reiterate that, I think also offering some relief maybe or encouragement here for investors at this point. But again, the stock has pretty much been all over the place since reporting those earnings earlier. But right now, an hour into the trading day, we are looking at gains, and it looks like investors really focused on that future growth and some of the momentum that On Holdings has displayed in the first half of the year.
All right, well, we're going to continue to focus on some of the retail names here. Coming up here, we're going to look at Home Depot. Those shares up nearly 0.5%. This comes after the stock was under pressure after the company slashed its guidance on weak consumer demand. We're going to get analyst reaction on the other side of this break.
Shares of Home Depot are actually now edging slightly higher, up just about 0.3%, reversing those earlier losses. The slowing housing market and also weakening consumer demand weighing on the home improvement giant once again this quarter. The company reporting its 7th quarter of negative comp sales. They also cut their guidance, now expecting sales to decline by 3 to 4% this year. Here to react to that report and more, we want to bring in Adam Baumgarten. He is a managing director at Zelman and Associates. Adam, it's great to have you here. So I'm curious, let's just start with the stock reaction here, because the stock had been under pressure initially following these results. Now we're looking at slight gains just above the flat line. Is that a bit of a surprise to you, and why?
You know, not so much of a surprise, and by the way, thanks for having me. I think coming in, the expectations for a miss on the quarter and some level of a guide down. I think if you dissect their guidance, you have a 3 to 4% comp decline. On the 4% side, that is a deterioration further in the consumer, which I'm guessing investors are maybe not assuming that. So saying, okay, maybe that 3% was within expectations. Hopefully also kind of the trough, and then we see some growth from there. So you're kind of bottoming out or maybe cutting the guidance and then resetting expectations to move higher. It's the only thing I can think of, but I think broadly speaking, it was in line with expectations.
What did you make of the broader report? I mean, the comp sales stood out to me because of the pressure they've been under for so long, for 7 quarters now. That tells me that maybe it's not indicative of the latest trend of consumer weakness that we all love to talk about. It feels like it's lasted a little bit longer, but what did you think?
Yeah, I think you've been seeing a normalization in home improvement spending in general. So there was the huge surge, as you know, in 20 and 21, and we've been giving back some of those gains. Part of that is the shift in share of wallet from goods to services. And I think even within goods, you saw a surge in home improvement and then people buying other things over the last few years. So some of that pull forward is still normalizing. We think that is back to somewhat normal as a percentage of overall consumer spending by the end of this year. So that's why we think next year you do return to growth for comps at this point. But any kind of recession, which is not built into our forecast, could push that out a bit more. Also, I think there was a bit more optimism earlier in the year as there was more of an outlook for rates coming down earlier in the year. And now that's been pushed out, as we all know. So that has a lagged effect on home improvement spending. So that's probably more of a 2025 phenomenon versus I think most people thinking in the back half of this year it would have been a bigger contributor.
So a big driver is this very much more so, and we heard this from the executives this morning on the call, is it very much a deferral mindset versus continued weakness that you're expected to see, just given the fact that we could see a return of some of that spending once we do get lower rates?
Yeah, I think it is a bit of a deferral. You're starting to also see home prices start to flatten out. They've been a nice positive story, even in a market where existing home sales are pressured. So I think a couple things. If you continue to see home price growth, and then you start to see that turnover pick up, which has been absent the last couple of years, down about 20% per year over the last couple of years, on the margin, that does tend to help home improvement spending as homeowners, when they sell the home, they fix up the home a little bit beforehand, and then the new owner tends to spend money on it. So I think that's probably a catalyst as we move forward. And we're starting to pick up within our network of contacts that listings are picking up. So that supply is finally starting to hit the market. The question is, are people going to be confident enough to buy a home in this market where with all the talk of recession and things like that?
Well, what are you looking at in your models to suss out that question? Because we were talking about how you only cover housing as a firm, and I wonder how you have stocks that are doing positively in this environment within that, right? So what do you look at to determine that the housing market is on track for recovery?
So we look at, as I mentioned earlier, that share of PCE. Now, we don't forecast consumer spending overall, but within PCE, we use kind of the consensus forecast, and that's for growth. And historically, you've seen a home improvement market grow about 3 to 4% per year. And that's what Home Depot's talked about. And that's kind of where we expect the industry to get to next year. And part of that is some of that positive home growth you're still seeing. Consumers are still in okay shape. There has been some level of deferral. And I think what's important within the spending is you saw the discretionary piece really skyrocket when home prices went up and we were getting stimulus and things like that. But there was also a pull forward of traditionally maintenance-driven spending. So think about you got to replace your roof, faucet breaks, appliance breaks, you typically fix it. That's, by our estimates, about 30% of demand. That was also pulled forward into 20 and 21. People had the money. They were maybe spending more time at home. They said, you know what, I know I need a new roof in a few years. I have the money now, I'll do it. So there was some pull forward of that. That's something that we think is behind us, and that continues. That's kind of a GDP type grower. And then I think you just see the reversion to kind of typical consumer spending patterns in home improvement starting next year.
All right, Adam, thank you so much for joining us. Really
Thank you.
Appreciate you coming in studio as well. Thank you so much. Now, coming up, we're going to have all of your markets action ahead, so stay tuned for more. You're still looking at gains across the major indices, the S&P and the NASDAQ, moving to the upside and holding on to their earlier gains. You're watching Catalysts. Let's turn now to immigration. It's one of many topics former President Trump discussed in his conversation with Elon Musk on X. Trump promising the largest deportations in history if elected come November. Now, this comes amid cracks that we are starting to see in the labor market, which caused a week of volatility for markets. But according to the Brookings Institution, U.S.-born employment saw a boost in 2023, while foreign-born employment also increased more than published data might be indicating. Let's bring in Brookings Institution Senior Fellow in Economic Studies, Wendy Edelberg, for more. Wendy, it's great to speak with you. I do just want to start on the comments that we heard from former President Trump last night here, again, promising those largest deportations in history. Talk to us from an economic perspective about the implications of a potential policy move like that.
So, generally speaking, the U.S. economy does not do well with abrupt changes of any kind, let alone massive increases in outmigration. So that would have very significant negative effects for labor supply, but it would also affect the communities where immigrants live. And those communities would see sharp reductions in demand for their goods and services, sharp reduction in demand for housing. Those communities would be upended. Schools would have done investment in anticipation of educating immigrants' children, and then those students wouldn't be there. This would be potentially extraordinarily disruptive for the U.S. economy.
Wendy, talk to us a little bit more just about the dynamics at play, how much immigration has changed those dynamics. And when we take a look at the BLS report that we get on a monthly basis, or take a look at those jobless claims report numbers, how does the factor or the number of immigrants here in the U.S. today versus what we saw years ago, how is that affecting how we should be viewing these numbers? Meaning 200,000, is that the new base? Is that maybe not as strong as what initially would have been given a decade ago?
You're absolutely right that the immigration surge should fundamentally change how we interpret the employment report. So these are very significant increases in labor supply that we've seen. And the result is that if you were coming into 2023, 2024 with the kind of number in mind of like 100,000 a month in employment gains, in payroll job growth is a good number. Now, double that. So the full employment maximum sustainable pace of monthly employment growth is now just shy of 200,000. That's why the number that we got for the July employment report of 114,000 jobs increased on net over the month of July, that number before the pandemic would have been a very nice, solid number. But now, in the context of the surge in immigration, that number is shy of what is sustainable given full employment.
Well, help me put a bow on this, Wendy. Let's say that you were speaking with Jay Powell and he was asking you for some insights that you have that we're not necessarily getting from the labor market data to the point that you just made. What is the single biggest data point that you see in your day-to-day that you would want to point him to?
He should be a lot less worried than he might have been about how strong the labor market looks. So now the labor market can actually run at the 3-month pace that we saw of 170,000 over the last 3 months. That's a perfectly healthy pace for the labor market without putting unwanted pressure on inflation. So he has a lot of reasons for concern and a lot of things in the economy that he's worried about. How strong the labor market is, worrying that it's too strong, that is a concern I wanted to take off his plate.
All right, Wendy Edelberg, great to get your insight here this morning. We appreciate you taking the time. Senior Fellow with the Brookings Institution. Thanks so much.
Thank you.
Oil prices easing as traders weigh OPEC's cut to its 2024 oil demand forecast. You're looking at a drop for crude of just about nearly 1.5%, Brent off by just about the same. Meanwhile, former President Donald Trump calling for lower energy prices and more oil digging here in the U.S. during an interview on X. Let's take a listen.
The cost of heating your house and cooling your house, that has to come down. It's gone up 100%, 150, and 200%, and that has to come down. When that comes down, and we're going to drill, baby, drill.
Drill, baby, drill. It's something we've heard from former President Trump time and time again. All right, for more on the oil markets and some of the action that we're seeing, Yahoo Finance's Jared Blickery. Jared.
Guess what drill baby drill means? It means lower prices if that happens. And the OPEC Plus is considering something very similar. And that has to do with that report you were talking about where they lowered their demand they lowered their demand expectations for 2024. But all the focus is really on what OPEC Plus might do in October, November, December. That is the fourth quarter of this year. They may be increasing their output by 543,000 barrels per day. They are currently holding back millions of barrels per day. So this would only be a modest increase. Nevertheless, they might be hesitant to do that because they're afraid that the world might need a little bit less oil than expected. Notwithstanding that, demand during the summer here has been very high. And in fact, the global stockpiles declined by 26.2 million barrels in June. So currently demand is high, but they're seeing that kind of wane in the future. And if OPEC Plus were to cut those 543,000 barrels per day in the fourth quarter, that would lead to an accumulation of 860,000 barrels per day next year. So let me tell you what all of this might do to the price. What we're looking at here is Brent crude oil. This is the standard over in the Middle East. This is the benchmark that they use. They need, and by they I mean the Middle East in general, needs about $100 per barrel of Brent to break even on their finances. Now, if they just arbitrarily start pumping more, that's going to send the price down. And that's going to mean that they probably won't get as many government receipts. If they do the opposite, well, price goes in the opposite direction. But it's all a very delicate balancing game. And I think the big wild card here is President Trump. What would his energy policy be? And I'll leave you with this note. A lot of people said during right ahead of the first Trump administration that traditional energy prices were going to soar. Clean energy would take a hit. That was the opposite case. And in fact, that was something that happened under Biden. So for all the handicapping about what might happen with the election and everything, people got it very wrong last time. So take that with a grain of salt.
All right, Jared, thanks so much for giving us that broad overview there. We really do appreciate it, as always. Coming up here, Google is expected to reveal their new Pixel 9 phone later today. You can see shares of Alphabet up nearly 0.8%. We're going to have all the details when we come back. Google is expected to reveal its new Pixel 9 product line at their annual Made by Google event. That's later today. Our very own Dan Halley is on the ground and joins us now to give us a rundown of what we can expect. Dan, what do you got for us?
Yeah, Manny, the rumors basically have been all but confirmed, at least partially, by Google. They showed off a kind of image of their Pixel 9 and Pixel 9 Pro Fold. So really what we're expecting here is a slew of new smartphones, as well as that foldable. Now, they already have a foldable. It's called the Pixel Fold, aptly named, but this is going to be their next generation. And it looks like there's some big differences here. You can kind of see it there on the screen. There's the 9 and then the 9 Fold. And really what Google is doing here is pushing the kind of envelope for foldable phones, trying to make them more compact, more user-friendly, and more in line with what you're used to from a normal smartphone versus the kind of bigger, bulkier foldables that we've seen. Samsung also has a foldable. The company OnePlus also has a foldable. But really, when it comes to smartphones here in the U.S. And foldables, it's Samsung and it's Google. Google, a runner-up to its partner, Samsung. But we're also expected to hear potentially about a new smartwatch coming from Google. They've been in the smartwatch game for a little bit. They had their Pixel Watch and Pixel Watch 2. Believe it or not, they're pretty great. They have great designs, wonderful displays, a ton of information. Fitness, it's backed up by Fitbit's apps. So a lot of capabilities there when it comes to the fitness aspect. And then we could hear more about potentially earbuds and more phones, because 2 just isn't enough. So we're expecting to hear a little bit more there on the phone front, and potentially the hearables, I guess, front is what people call it now.
All right, Dan, thanks so much for joining us on that. And we'll, of course, be continuing to monitor all the news to come out of the event. Well, coming up right here, Yahoo Finance's Wealth, dedicated to all of your personal finance needs, is going to be here. Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we'll talk about the report all of Wall Street is waiting for, the Consumer Price Index report. We'll talk about how investors can prepare for the data, and we'll dig into some of the areas where consumers are feeling the heat on inflation. And we'll talk to the co-founder and CEO of Kinlock Partners, plus get the names of 5 cities where you can buy a big home for under $325,000. I got my pen, I'm taking notes, maybe a steal in today's market out there somewhere. Plus the cost of not taking your paid time off, that PTO. We're gonna discuss that and why you should book, perhaps pretty soon. But first, tomorrow, we're going to get a read on the latest inflation data. Consumer Price Index report set to be released. Whether it comes in cooler or hotter than expected, there might be a way to protect your portfolio, no matter what. To discuss this, we've got David Wagner, who is the Aptus Capital Advisors Portfolio Manager. Dave, great to speak with you here. All right, so let's put this in context, put this in perspective, where we are in inflation right now and where investors can be positioning their portfolio going into and out of the print.
Yeah, Brett, thanks for having me back. But I would say that, deflation, it's become less of a market catalyst than what it was, say, 12 months ago. But I mean, who doesn't know that? I mean, there's a lot of things out there that the market believes that it knows right now. It knows that if inflation continues to come down, that we're likely going to see Fed cuts in September. I mean, look at the Fed pricing right now. We're looking at an 80% chance of a cut in September. But let me, Brad, say that in a different way. If this CPI report is a disappointment, say we get a core number around 3.4% or higher, or a headline number at 3.1% or higher. If we get that higher than expected number, then a quick, sharp drop in stocks, well, that shouldn't be too surprising because, again, it's widely known right now that inflation is falling, and 2 is that the Fed is likely going to be cutting in September. Bottom line, if CPI reinforces that message, the grind higher can continue. If it refutes that message, don't be shocked if we see some type of volatility in the market over the next week or two.
And so even with that volatility, because what you're talking about there is now we've gone from bad news being good news because then, and months ago, it was, okay, that puts us further towards the rate cutting pathway and that initiating. But now bad news is becoming bad news because it's signaling that the Fed might be behind what the markets were anticipating, or we might see even a recession. I want to get your purview, your own perspective on that. And then additionally here, I mean, in my inbox this morning, I'm still looking at emails with the headlines that say from a few different firms out there signaling, hey, stay invested right now, despite the volatility.
Yeah, no, you're exactly correct. I have one saying, and for some reason, it's very difficult for a lot of investors to comprehend, but it's very simple. Follow the tape. Follow what the market is telling you. And if you've already been looking and watching the fixed income market, say over the past, 4 or 5 months, you've seen the 2-year Treasury come down 100 basis points. You've seen the 10-year Treasury also come down 80 basis points. So I think if you're looking to, fleet to safety in case there's some type of bad report or a good report, I don't think it's in the fixed income area, perhaps because you've already had quite some type of move. So the market is telling you, if you follow the tape, that we know that inflation is coming down. And we know that rates are also likely to be coming down as measured by the Fed funds rate. I think kind of the coy or the cool way to really play this market on following the tape, since there is an opportunity, in my opinion, on the fixed income side. But if we do see rates come down, the best asset class always when rates are coming down are stocks. People always forget that stocks are one of the longest duration assets out there in the market. And if rates come down, I think that, a rising tide is really going to lift all ships in the equity market, probably a little bit more specifically on the cyclical and small cap side, obviously, but I would still want to be owning stocks in that type of environment.
Where would volatility net out for some of the larger cap tech names out there, those that have been darlings in the broader AI theme?
If we get a better than anticipated, CPI report here, I do believe rates will come down. And I think those magnificent 7 names, they're going to continue to be that funding mechanism, much like what we saw in the middle of July. And you saw that capital flow from the Magnificent 7 to some of the smaller cap cohorts, to more of the real estate investment trust areas, the utilities, and even some of the more consumer cyclical and the consumer discretionary area. So that's what I would probably expect. If we see a worse off, so a higher than anticipated CPI report, I do think that the flow of capital is going to remain with the Magnificent Seven because there's so much resiliency, there's so much pricing inelasticity that a lot of those companies have, and that's the new flight to safety. The flight to safety 10 years ago was the staples, was the utilities, but in this new era of investing in AI and the amount of profit margin operating leverage that a lot of these Magnificent Seven companies have, that's where the flow of capital is going to go if investors are looking for safety. And so if you think that there's going to be volatility in the market, not just here in the near term, but over, say, the next 3-4 months, I'd be putting my capital in the Mag 7. And Brad, I actually don't think that's a consensus call. I think that's kind of the anti-consensus call, which makes me probably a little bit more even convicted in that thesis.
Just lastly, while we have you here, David, as we're thinking through the earnings calls that have already taken place, I have one note in my inbox, and it's forwarded from the chief economist at Apollo, and all of this looking at the amount of mentions on recessions and earnings calls here. And companies are talking less and less about recession on earnings calls, looking at and charting even back to 2006 at this juncture. What does that signal to you about how concerned companies are and what investors should expect, especially as it relates to what they're saying about their financial performance, even amid the macroeconomic environment where they're not talking as much about recession on these calls?
Yeah, bro, that's great anecdotal evidence. I would like to see where that figure stands, not just at the end of this week, but maybe at the end of like 2-3 weeks from now, because we're starting to see, especially this week, the more cyclical discretionary companies reporting. You have Home Depot, you have Walmart, you have Lowe's this week. Next week and the following week, you're going to get a lot more of the smaller capitalization companies that are a little bit more tied to the cyclical aspects of the U.S. economy itself. So I'd kind of like to see that data come through, in the next 3 weeks, because right now the market is so tied to consumer spending, and that's where a lot of people are seeing cracks in the macroeconomic data is on the consumer spending side of things. So I'd want to hear that management commentary if they're starting to see cracks, depending whether it's on the higher end cohorts of the income distribution or on the lower end.
David, always a pleasure to speak with you. Great to check in. David Wagner, who is the Aptus Capital Advisors Portfolio Manager. Thanks.
Cheers.
Yeah. This week in markets, Wall Street looking ahead to the Consumer Price Index out on Wednesday. Now, CPI, it measures the monthly change in prices paid by U.S. consumers. The index represents a basket of goods such as eggs, meats, baked goods, and services such as medical care and motor vehicle maintenance. The significance of this data is that the Federal Reserve is looking for more evidence of inflation moderating towards its 2% target in order to feel comfortable initiating a rate-cutting cycle, but there are certain areas of the inflation report that have remained sticky. Here with more, we've got my morning brief co-anchor, Shauna Smith. Shauna, thanks for sticking around.
Of course, thanks for having me. You're right. So the big focus tomorrow is going to be on that CPI print and exactly what we have seen. Let's talk about some of that improvement that we have seen over the last several months compared at least to a year ago. So that latest reading on inflation that we did get showing prices are about 3% higher than just about a year ago. While it's still painful for millions of Americans, it's actually a huge improvement from peak inflation, and that was at 9.1% back in June of 2022. Now, despite some of that improvement, though, Americans, they are still struggling. A survey from a firm found that 60% of people believe the U.S. is actually currently in a recession. And the biggest reason for that, well, it's inflation and the rising cost of living. So let's take a look at 3 areas where Americans are feeling the most pain. You've got shelter, food prices, and car insurance. Kicking off with shelter. Now, shelter costs are up more than 5% from a year ago. The mortgage rates, although on a decline, sit just below 6.5% for the 30-year fixed rate. That number is still high. So high home prices and elevated mortgage rates here exacerbating the country's home affordability issue. And it's not just for homeowners. The cost of rent is actually also up more than 5% from a year ago. Now, the second area where Americans are facing higher prices, that's food. Food prices are up more than 2% from a year ago, and eating out at restaurants, what the CPI report dubs as food away from home, those prices are actually up more than 4%. Some notable calls out here: the cost of your crackers and bread, that's up 4%. The cost of your meat, up 3.5%. Pork is up 4%. Eggs are up 10%. And rounding it out with car insurance, that's up nearly 20% from a year ago. According to Bankrate, the national average for full coverage car insurance is nearly $2,300 a year as of last month, or just about $190 a month. So yes, Brad, inflation has improved overall on that headline number, but it's no surprise that Americans are still feeling the pain of higher prices. And a big reason for that is because of these higher costs, a lot of that having to do with inflation. And it's also no surprise that this has also been a sticking point here as we lead up to the 2024 election. Sticking point here for the Trump campaign trying to attack Vice President Harris and her track record under the Biden administration for some of the pain that millions of Americans are still feeling at this point.
Shauna, thanks so much for breaking this down. Of course, we're going to have the live breakdown tomorrow on CPI. Can't wait.
We will.
All right, guys. Appreciate it, Shauna. Turning now to a C-suite shakeup, everyone. Chipotle's current CEO, Brian Niccol, will be taking over at Starbucks. This is effective September 9th. And to take a closer look on Niccol's track record at Chipotle and even some times before that this stems back to, we've got Yahoo Finance's very own Brooke DePalma here with us. All right, so he's finally leaving the business of tacos and burritos. I mean, formerly Taco Bell, then Chipotle, and now coffee in the morning?
Now coffee in the morning. I think John Tower put it best. He said something like burritos to cold brews. So it definitely is a switch up. But Brian Niccol does have a pretty good track record when it comes to stock momentum, revenue at Chipotle, and also just the overall culture of Chipotle that has been transformative under his leadership. Taking a closer look at that stock momentum since he joined the helm of Chipotle in March of 2018. Shares are up more than 770% since he took the helm there. Now, it's worth noting that back in June, you and I, we all discussed that 50-for-1 stock split. It was the company's first stock split, and it was also one of the largest in New York Stock Exchange history. And in addition to that, given that stock momentum, many investors at Starbucks, many analysts saying that this could then prove forward in Starbucks. Peter Slice saying in a note that Mr. Niccol has earned the respect and confidence of the investment community and will be given the much needed leeway to make investments in time to turn around Starbucks. Moving along to revenue, since Brian Niccol joined the year before in 2017, there was a revenue of $4.5 billion for Chipotle's annual revenue in 2017. By 2023, that revenue doubled to $9.9 billion. And it's worth noting that some things that Brian Niccol could bring to Starbucks that he did at Taco Bell then brought to Chipotle was really this intense, or rather effective, marketing strategies that really were what Andrew Charles of TD Cowen said were the backbone to Chipotle's turnaround since 2018. So we could see Starbucks come back on top, figure out that premium identity that it's had so long, and perhaps see some of those cultural moments that he made happen at Chipotle. And lastly, the culture at Chipotle. There's this career roadmap for Chipotle employees that is pretty impressive at the company. A crew member can come in making $38,000 and rise up to a regional vice president making $624,000. It's worth noting that over 80% of managers at Chipotle started out as crew members. And of course, Brad, we know that Starbucks has had this long-running issue of really building up momentum, making sure that you're building up from within, and that employees truly do feel valued and that they could stay with the company and really work their way up. And so Niccol certainly does bring that. I'm speaking to many insiders within the company, and their stories are truly incredible over at Chipotle about how much they've been able to not only work for Chipotle, but how much this opportunity, this employment, this job has done for their families as well.
I'm looking at the number of stores that are operating. I know we got to wrap here in a second, but I'm looking at the number of stores that are operated and the difference between the time that Brian Niccol took over at Chipotle when it was about 2,363 as of the end of 2017, and now looking at over 3,500 restaurants as of June 30th, 2024 here. You think about that growth and how that's also contributed to the revenue number that you're talking about. I think the larger question for him is the regions that Starbucks operates in. How do you fine tune that experience? He was bringing Chipotlanes into Chipotle, and so
big
now
digital transformation behind Niccol's tenure at Chipotle, and also too, it's worth noting. Brian, Zazie, and I, we were all chatting this morning about this, and you know, of course, there's Yum China. So Taco Bell is operated under Yum China, but China is a big segment for Starbucks that has really struggled yield as of late. And Brian Niccol had a brief touch in that back in 2017 when he was at Taco Bell. And so it'll be interesting to see how he brings that experience as we're seeing flagging sales in China to Starbucks.
All right, we could talk about this all day. We have been talking about this all day, but for good reason here. Brooke, thanks so much. Appreciate it. Well, small business owner optimism is on the rise. That's according to the newest numbers from the NFIB Small Business Optimism Index. The 93.7 reading for July, the highest since February of 2022. But that's still below the 50-year average of 98. Here to help us break down the latest figures and to give us some insight into how small business owners are feeling these days, we've got Holly Wade. She is the NFIB Research Center's Executive Director. Holly, thank you so much for joining us here. I just want to get your broad read here on where we stand with this reading and what's jumping out as some of the most pressing issues for small businesses right now.
Sure. So thanks for having me on your show. The index did jump 2.2 last month, which was a great sign that things are easing up for small businesses across the country, especially their outlook for business conditions. That improved 18 points from June. And it was a great kind of signal that small businesses, those headwinds that we've been talking about for months now, are starting to ease up. So sales expectations going forward improved. Those planning to increase compensations fell a bit. And also those that are increasing prices fell also, and those planning to increase prices. So all of those headwinds, the inflation picture, even though it is still the single most important problem for 1 in 4 small business owners, those pressures have eased. And that's a great sign for small businesses in looking forward and how they're dealing with operating their business, the uncertainty element that still is a focus for many of them, what the 6 months look like as far as business conditions. But those headwind pressures that we've been talking about for the last number of years, they are easing up, and we've seen that index increase and are supported by all of that over the last 4 months. And so that's a really great sign for us looking at the small business sector.
I want to come back to the employment side of that, but let's stay on the pricing element, as you were just mentioning a moment ago. And the stat that you had mentioned, the net percentage of owners raising their average selling prices actually fell 5 points from June to a seasonally adjusted net 22%. How is this expected to impact volumes, how much they're able to work through?
Certainly. So last month, there was a higher number of those that said that they expect sales to increase. They're working or competing with their neighboring businesses, so they're having to kind of adjust those prices accordingly to keep their customers. We all know that consumers and also businesses are having a bit of price fatigue. They are not enjoying the last couple of years of having to increase prices more than they ever have before, or more frequently than they have before. So easing off those pressures have relieved a lot of stress among small business owners. And they're expecting sales to even improve over the next 3 months. And that's a great sign for those small business owners still navigating a lot of these headwinds, but the headwinds aren't quite as strong as they have been.
Okay, and so as of right now, how are small businesses investing back into their own businesses? Where are those capital outlays expected to move from here? And how could that also perhaps give us a little bit of insight on where we might see them do even more hiring?
Sure. So we're looking at still record levels, highs of those unfilled job openings that have been very elevated for a number of years, remain elevated. So that's a good sign going forward that the employment sector of small businesses it still remains very strong. As far as capital spending, that has been pretty tempered over the last couple of years. Not as much as we would have normally expected in a growth environment. But interest rates, even though financing is their number one source of financing, our profits, those interest rates are really expensive for many small business owners. And so they're hesitating a bit on whether to make those big expenditures, maybe wait for a couple months to see if the cost of financing starts to ease up a bit and become more affordable for them.
Holly, great to catch up with you. Thanks so much for taking the time here with us. NFIB Research Center's Executive Director, Holly Wade. Thank you.
Thank you.
Coming up, everyone, looking for a more affordable home? Well, we'll tell you where to look when we come back. Home Depot is out with their quarterly earnings, and that dropped this morning, offering another look at how consumers are spending their money. For more, we have Yahoo Finance's housing reporter, Danny Romero. Hey, Danny.
Brad, consumers are still hitting the snooze button on big projects. People are delaying kitchen and bathroom projects, especially due to the high interest rate environment that we have been. Executives at Home Depot said that there is expectations that rates will come down. And if that does happen, then there could be, that's one of the reasons why people are deferring projects. But due to the pullback, the company is guiding comp sales to decline about 3 to 4% for the fiscal year. Now, Wall Street is expecting that the Fed will cut rates starting in September next month, and that could help with the turnaround story for them. Remember, Home Depot has reported 7 straight quarters of negative sales growth. U.S. same-store sales are down 3.6%. So if rates do come down, that would provide relief for consumers who are looking to still remodel or fix up some part of their house, or even sell their home for that matter.
Yeah, indeed. The company saying, and these 3 words stuck out to me: pressured consumer demand more broadly here, and the more broadly, of course, that makes it 5 words, but all things considered, that's what resulted in this weaker spend across home improvement projects. While we have you, let's continue this frame of mind on the housing sector. You have some new data on the apartment construction records that we've seen. I mean, what type of highs are happening there?
The apartment market is set to break records this year. More than 500,000 rental units will be completed nationwide. That's according to Rent Cafe. That's a 9% increase from last year. And New York is going to lead by 33,000 new units, and it's driven really by a surge in Brooklyn. Dallas and Austin are right behind New York. And in theory, let's talk about this, more supply would help push rent prices down in some areas. We're going to talk about Austin, for example. Zillow reported that rents fell on a monthly basis in Austin. So this is one metro that has seen a lot of construction being added to the market. New supply, though, means competition. So more property managers are actually offering concessions, whether that's free parking or even a few weeks of free rent. So that means that if you are a renter right now, you have some advantage. You are more likely able to sweeten that deal, that rental deal. But looking ahead, Rent Cafe says that they are expecting 2 million new apartments by 2028. I can't believe we're even saying that number.
What?
But there is expectation that there will be a slowdown because rates are still high. Construction costs are still pretty heavy right now. And so if we factor all these macroeconomic dynamics, there is expected to be some pullback in construction. So yes, this record for this year, great. Next year could be a different story.
All right, come on, New York. Let's do our part. Let's bring down some of these rental prices. Danny, thanks so much for keeping tabs on these key metrics, giving us a sense of the housing market right now. Appreciate it. Well, since we're talking about housing, let's go further. Housing is expensive, and it's not just rents. Home prices just keep getting higher. The median sales prices, particularly here for new and existing homes, rose once again in June, with this data according to the Census Bureau and the National Association of Realtors. So where in the U.S. can someone find a home for more affordable prices, say under $325,000? We're just throwing ballpark figures out there. Let's get to our next guest. They've got some answers. Bruce McNeilage, the co-founder and CEO of Kinlock Partners, joins us right now. Bruce, thanks so much for taking the time. All right, so where are those deals to be found and under this, $325,000 price range?
Brad, that's a great question. It's all over the Southeast and the Midwest. You can find houses, 4 and even 5-bedroom houses under $300,000. You just have to look. And I'm talking about entry-level houses sold primarily from the national builders, and they're plentiful. There's not a shortage of them. They're all over the Southeast, Indianapolis, into Oklahoma City, throughout the Midwest.
With this in mind, I mean, where are some of those hot markets right now? I think we have 5 of them that we've been looking into along with you here, and we've got them up here on the screen. So why some of these areas, and many of them in that South Carolina, Georgia area in the East Coast here?
Yeah, so land is plentiful and land is less expensive than some of these other cities. So you get cheap land, you control your cost on building. Labor is probably a little less expensive in the Southeast, and that adds up to an affordable house. But it's basically the land, the cost of the land, and as cheap as you can buy the land results in a lower priced home.
All right. Yeah, and I was looking at Spartanburg, South Carolina, that was on that list as well. I mean, of course, some automotive manufacturing operations there, too, that could perhaps be an opportunity for people to look to get into a new home there, as well as perhaps even get a new job in the area. We'll see. Also saw Houston, Texas up on there. So at the end of the day, are prices going to, on the national level, do you foresee them abating anytime soon?
No, I think the opposite. They're going to increase. We're several million homes short in this country of houses. The demand is there and the supply is there. It's just getting people approved for a mortgage. Some of the builders are doing a great job by buying down those rates to 5%, but we need affordable mortgages, and that will drive the housing market, and that'll take some of the supply out of stock, and you're going to have prices increase, not decrease throughout the country.
What is the new benchmark? Is there a new rule of thumb for how much you should be ready to put down as a down payment in order to look like a very viable and trustworthy person to give that mortgage to?
Yeah, so if you're doing programs like VA loans, you can put down as little as 3%. Most people are putting down 10 to 20%. And you've got PMI, private mortgage insurance, if you put down less than 20%. So what we're seeing is people are putting down less to get into these houses. Now that drives up the payment a little bit, but it's an affordability factor. The less money you have, if you want a house, you've got to go for those loans that you can get into for just 3 or 4% down, 5-10% down.
Bruce, just lastly, while we have you, we were just talking in our previous segment, I'm not sure how much of it you may have heard about rent prices right now. When you see rent prices in specific cities continuing to try and moderate lower, but struggling to do so even with more capacity coming online, how much is that expected to overflow into other markets and make it so that people who are looking at housing opportunities and purchasing elsewhere are able to get out of cities that have egregiously high rent, egregious, especially in the cases like New York, San Francisco, and I will say DC as well, because I lived there at one point?
Yeah, that's a great question. So interest rates affect homes and what people are doing as far as buying homes. But when you look at the rents quoted, they're giving incentives for apartment communities, 1-2 months free rent, maybe reducing security deposits. But to rent a single family home, we're not seeing those decreasing in pricing. And quite frankly, we're not seeing too many incentives. So the rent decrease is primarily in the multifamily apartment style units. In single family home rentals, we're just not seeing a decrease or seeing incentives.
All right, Bruce, with a holistic look at the entire housing landscape there. Bruce, thanks so much for taking the time. Bruce McNeilage, who is the Kinloch Partners co-founder and CEO. Thank you. Well, what's your earliest money memory here? It might tell you a lot about your current relationship with finances. We're going to tackle the psychology of money right after the break. Stick with us. Ally Bank rolling out a money wellness curriculum to teach people how to work on their emotional relationship with money. To discuss how you can use psychology to get your wealth goals and hit them, Jack Howard, Ally Bank's head of money wellness, is here with us in studio. Jack, thanks so much for taking the time here.
Thank you for having me.
Absolutely. Let's dive right in here. What exactly is this program designed to do?
Well, it's designed, when we think of money, everybody thinks about the skills. So it's understanding your budget and your credit. Those are the things that we typically learn with personal finance. However, for most people, implementing those skills can be hard because you do not have an understanding of the behaviors that may stop you from doing that. So your subconscious beliefs, things you may have learned from your parents or society, all impact your ability to actually implement those skills. And that's what we're doing with Money Roots.
I mean, there's so much psychology that plays into your financial status and how you're kind of bettering some of the smart spending habits that you have. So how do you kind of go step by step in breaking down the psychology as well around money decisions?
Really, it's your emotions around money, the things you learned from childhood, and that's what we're doing in Money Roots. So we have a 4-part curriculum. The first is really diving into your money and emotions. Are you feeling anxiety? If so, how do we deal with it? The second one is your money story, going deep into your early money memories, really charting out your relationship with money from, beginning to now and how that impacts your financial decisions today. The third one is your money and values, which is one of my favorites, going deep on what are your core values and how does that show up in your spending and saving decisions. And then finally, money and love, which is one I think we all need, right?
It's gonna step on toes.
But we need it. Really going deep on how does the money story show up in your romantic partnerships? What are the beliefs that you and your partner have and you're bringing into your relationship? And then how do we move forward? So we're going deep into understanding your mindset with money and how we now chart a better path with your wealth.
I'm always interested in knowing how financial institutions are really tracking the perhaps perceptions of money and saving across generations as well, because we've all gone through different events over the course of our financial planning and financial future outlooks. So how does that look, across generations from what you're seeing too?
Yeah, definitely. We're finding that our younger generations are becoming more open to understanding what is financial wellness compared to our older generations where it's more of the skills. So it's becoming a more holistic approach as we think about money of it's not this separate silo that we can keep in a box and only come to occasionally, but it's holistic. It's how you feel about it. It's your wellness. And we got to make sure we're bringing all of that with Money Roots.
How do people, especially given some of the recent market undulations that we've been tracking and slippage, how do people best manage a money mindset and the psychology that they could perhaps employ during a market slip?
Yeah, we actually did a study and found that nearly half of Americans are using their emotions and it comes up with their spending. So when you look at the market, everything that deals with money, we're having anxiety, we're having all of these emotions and not acknowledging it. One of the first things we do in the Money Story Workshop is we just have a set of how are you feeling about money right now? If I ask you quickly, money is, what comes up for you? And for a lot of people, you'll hear a range of answers. I'm feeling anxious, I'm feeling confident, but we need to create space to where we can talk about those emotions, honor them, and decide what are the tools that we can use to move forward to navigate it better.
Okay, all right, I'm gonna ask the question, even though I know there are gonna be a lot of people out there that could benefit from this, but don't wanna hear about it immediately, or perhaps it's just a sensitive topic, but how future spouses should be talking about money.
Thank you for asking.
I know, exasperated sigh, everybody just get it out.
No, let's talk about it. First, we got to talk about it. It's a conversation that needs to be had beyond pulling your credit report. So one of the first things I want you to ask your spouse, what is your first memory of money? What were the beliefs that you learned from your parents and society about money that now impact you? Let's have that be the first conversation. And it creates so much empathy in your partnership because you may have, and opposites tend to attract, you may have one person that's more frugal, one person that's more of a spender, and you can bump heads. There can be a lot of judgment and a lack of empathy. I want you to come into the conversation being vulnerable, talking about your past, and now we can understand, oh, you're a spender because of this from your past, or you are more frugal because of this. It creates that empathy, and now we can come to a place of creating a plan moving forward as a couple without judgment.
Right. So on the other side of that, how can, and I guess in tandem with it, How can couples move through money trauma that they may have experienced in the past as well? Insecurity with money.
Yeah, so we first go through that money story question. Next, we want to go into what are those topics that are hot topics for you as a couple. So it may be, should we have shared bank accounts? What are your views on spending and saving with family? Do we give money to family members who need help? So you want to bring that to the forefront. And then from there, let's create a money motto together as a couple where we can look at what are our goals for our family financially, what are the values that we want to have that comes with money, and create that to move forward. But you gotta have the conversation.
You gotta have the conversation. Jack Howard, Ally Bank's head of money wellness here, joining us. Thanks so much for taking the time.
Thank you for having me.
Absolutely. Novo Nordisk, Eli Lilly, Hims and Hers, all seeing increased demand for diabetes and weight loss drugs. In response, more employers are offering insurance coverage of these drugs up to 34% now, from 26% in 2023. That's according to a survey by the International Foundation, I should say, of Employee Benefit Plans. Employers' overall medical claims spending on the medications also rose to 8.9% so far in 2024, from 6.9% in 2023. So, how do you know if your job provides coverage? Our next guest has a solution, and I'm joined by Zach Reitano, who is the co-founder and CEO of Row. You also stand to benefit if more employers start to cover what they hadn't before here. So Take us into the thinking for Ro's business, and are you seeing the same type in spike and demand here that we're hearing from companies like Hims and Hers who just raised their own guidance because of that demand for weight loss drugs?
Yeah, thanks for having me on, Brad. We are seeing overwhelming demand for our Ro Body membership, which is high quality care centered around GLP-1s. Why we built this tool is because after helping hundreds of thousands of patients start their weight loss journey, we saw that the number one problem that they had was understanding their costs at the beginning of their journey. And that should be table stakes in any experience, let alone healthcare. And the difference between being covered and not is a few $100s a year if you're covered usually versus $12,000, right? And when patients don't know if they're covered, what that ends up doing is it prevents people from seeking care in the first place, which is the number one reason why patients don't start that journey, is sort of the unknown cost. So we built this tool to help patients understand whether or not they're covered and how much they would have to pay to get access to GLP-1s. You put 34% there. We're actually seeing higher numbers than that on our side. We're seeing about 45% of our patients be covered. And when they are covered, the vast majority are paying less than $100. And so when you're covered, you're really covered. And so we wanted to build this tool to increase access to these treatments.
Should those prices be even lower? I mean, as of midpoint this year, it sounded like that the average price for GLP-1 drugs, I mean, and this is the list price, $1,000, but if you have insurance, obviously that comes down dramatically depending upon what you're paying into insurance. That could be even, $25 for a 1 to 3 month supply, according to, some of the compilation of the American Journal of Management, WebMD, and so forth.
Yeah.
So what is the true fair pricing for these drugs, given the demand profile that we're seeing?
Yeah, Brad, you're getting at sort of one of the largest sort of fundamental flaws of our healthcare system right now. The only people paying that list price, that $1,000, are patients without coverage or those that are uninsured. So patients with coverage, which you listed about 34%, again, we're seeing 45%. Because you'll have commercial payers. You also have about 18 states for Medicaid that are covering it. You do see Medicare cover it. All federal employees and their families have coverage. So you are seeing coverage rise. You have over 50 million people in the US who are covered for Wegovy. So when people are covered, which is tens of millions of people, the average copay we're seeing on our platform is about $50. So when you're covered, which is what this tool is trying to help people determine, are they covered or not at the earliest possible point in the journey to help them navigate next steps, we're seeing a very, very affordable price with coverage. And then hopefully over time, we obviously see these coverage rates increase. So that's, again, one of the challenges. That list price is unfortunately, it's way too high. We want them to come down. We're seeing more and more competition. We're seeing savings cards and we're seeing coverage increase. So hopefully over the coming years, we will see fewer and fewer people actually pay that list price.
When we think about the unknown costs of weight loss drugs, I mean, we know that, it changes how you might eat, changes the type of exercise you should be doing on the other side as well. What are some of those cost considerations because of the change in lifestyle that people should be keeping in mind even as they're having these key discussions with their medical practitioner or doctors?
Yeah, we've seen a lot of really interesting things, and what we talk about internally related to GLP-1s is we refer to them as a jetpack for positive behavior change. Because what we see is this immediate and positive feedback loop for patients in their life. So it kickstarts a lot of behavioral changes, right? So you traditionally see a reduction in about 20 to 30% of calorie consumption, but it's not just patients are able to eat less and reduce intake. Also, what they are eating dramatically shifts, right? They're eating more vegetables, more fish, more poultry. They're eating far less snack food or confectionaries or soda and things like that. And when they're able to do that, you're seeing them sleep more, you're seeing them exercise more, you're seeing them date more. So you're seeing a lot of interesting positive behavior change that are kickstarted by starting GLP-1s.
Okay, so get ready to date more. Get ready for those expenses.
That's right.
Zach, just lastly, while we have you, we only have about 30 seconds here, but I'd be remiss if I didn't ask you about how the business is doing itself. I know that you're a unicorn status as of right now, and your own story in itself is something really to be talked about in your own evolution from selling, I think it was tacos or burritos or something like that from a friend's couch. Look, we could go into that another day, but how's the business doing in this environment right now, and what is the next major milestone you're anticipating?
Yep, it's a great question. For us, we've been, as you mentioned, we've been really overwhelmed and excited by the demand for our products and services, and so growing incredibly quickly. We've helped millions of patients across the country, one in almost every single county across the U.S., and have helped hundreds of thousands of patients start their weight loss journey, and hopefully just the beginning for Ro and the team.
It was burritos, by the way, just for our viewers out there. You were doing the good work of ghost kitchens, but we're so glad that there's so much more work you're doing on the healthcare side as well here. Zach Reitano, co-founder and CEO.
Appreciate the time, Brad.
Thanks so much for hopping on.
Thank you.
Appreciate it. We've got much more on wealth after the break. You're watching Yahoo Finance. Feeling overworked this summer? Well, maybe you just need a break from that 9-to-5 job. Do yourself a favor, take some well-deserved paid time off. According to a new report from Sorbet, nearly 2/3 of Americans did not use all of that paid time off, the PTO days last year. This trend isn't just a missed opportunity for relaxation. You're also missing out on some serious financial gains as well. For more on what this means for both workers and employers, we've got Vital Ilat-Raichel, who is the Sorbet founder and CEO. Great to have you here in studio.
Thank you so much for having me.
Absolutely. So let's dive into, why aren't people taking their PTO?
Oh gosh, we've been tracking this data for a couple of years now. What we're kind of hearing consistently is a lot around optics and our collective kind of cultural complex relationship with the idea of going on vacation. Interesting though, in the last year, we're hearing a lot more concerns around costs, travel costs, general inflation and prices going up. But yeah, that's a huge driver. This year specifically.
I used to be a huge proponent of the staycation, and making sure that I was still using that paid time off, but even if I wasn't going anywhere, just that relaxation, that reset. So as we're thinking about where employees are even navigating through, do I want to go somewhere? Do I want to kind of stay home? How is this changing the type of vacations that they are taking or using that PTO as well?
Well, we're definitely seeing a lot more, these trending topics like workation and staycation and things like that. I think at the end of the day, what we need to acknowledge is that taking time off is important. It's proven to be helpful with reducing stress and improving productivity, and that if we try to glaze over that or try to find ways to do it, it's not going to be as effective overall.
Absolutely. There are states, and you've tracked this, you've been able to kind of look across the employment situation, states with worse than national PTO utilization. Which were the ones that stuck out to you?
Well, overall, like you said, 62% of U.S. employees don't use up all of their time. And on average, those employees will leave about a little over 30% of their PTO unused. That's actually a whopping amount. New York is actually a little over the national average. So New Yorkers will leave around 33% unused. So a third, that's almost a week of vacation that they could be taking that they are not. And then just to make you feel it a little bit better, we have states like California and Illinois who are around 35% of time unused, and the worst would be North Carolina with over 50% of time left unused.
Are we going to be able to avoid, and I've heard this tossed around quite a bit, are we going to be able to avoid a burnout crisis? Because this comes directly back to being able to have people feel confident taking their PTO and finding balance as well here too.
No, you're absolutely right. I think there are two ways to think about it. One is, as you mentioned, the burnout angle. People do need to take time off. It's better for employees and for employers that they do, because obviously over time this could come back, to be very, very significant overall. But there's also a financial angle to this. A lot of people kind of are programmed to think about paid time off in terms of days and hours that we can take off as vacation. But in fact, PTO is an integral part of our compensation. It has a clear financial value attached to it. And a lot of people don't realize this, but for most employees, if they don't end up using all of their time off, when they ultimately leave their employer, they're going to get paid the cash value of their unused PTO. So people really need to educate themselves around, how much their unused PTO is actually worth, and be very mindful of that portion of their compensation.
We got to go. Hopefully there's a one-word answer to this. Which generation is doing the best at utilizing their PTO right now?
The older you are, the better you are at taking time off.
Okay, sounds like the boomers are doing this quite well.
Yes, they are.
Vital, thanks so much for taking the time here in the studio with us.
Thank you for having me.
SoBe, founder and CEO. And that's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Guess what? You can stay tuned for Market Domination. That's with Julie Hyman and Josh Schaefer coming up at 3 p.m. Eastern Time. You don't want to miss it.